the curve. The two-year yield, we were talking about 470, then quickly 480, very quickly 490, and all of a sudden, overnight, we're talking about 5%, 496, and got very, very close to that 5 handle all over again. Yields pulling back just a touch by a single basis point, the 10-year at 454.57. If you're still sticking with June, you're clinging to PPI at 8:30 Eastern time, aren't you? And jobless claims too.
This morning, the question isn't, are you cutting your rate call for this year? It's really, why aren't you cutting a rate call for this year? Why is this not indicative of something stickier? And that's the reason why I'm actually very curious to speak with the Citigroup economists later on in this morning, because they're the ones that are clinging to June. And what gives them that sense that there still is an opening for the Fed?
Mike Gapin of Bank of America as well, by the way. And Mike Gapin had this to say yesterday, and let me be clear, still sticking with June for now. Here's the quote. We think that unfavorable base effects on inflation in the second half of this year mean that the Fed could be forced to delay the start of any easing cycle to December of this year or March of next year. So the longer you wait, the harder it gets to actually start.
Which is the political question, and the reason why this is such a fraught moment. Yes, this is a Fed that wants to be politically independent. However, anything that they do right now will be perceived as political, especially if they cut rates into inflation that looks sticky, into an economy that's printing north of 300,000 jobs a month, and they're talking about a really close election. This is a very difficult moment for a Federal Reserve that wants to remain out of the fray.
That's the Fed. Let's turn the board, switch out the board and get to foreign exchange and other central banks as well. And we'll sit on the ECB, 107.32 on euro dollar. We're negative on that currency pair by another 0.1%. Under surveillance this morning, the ECB decision coming at 8:15 Eastern time, with President Lagarde speaking at 8:45. Traders now expecting less than 3 cuts, down from bets there would be 4. A cut in June is still the base case, but it's no longer fully priced. And a conversation we started the hour with was how yesterday's news would impact tomorrow's moves from the ECB, the BOJ, and others too.
It's causing headaches in Frankfurt and also as well in Tokyo, because you see this weighing on the currency pairs. When it comes to June, though, and the ECB, Jonathan, you made this point a lot of times. Shouldn't the ECB already be cutting? And Christine Lagarde said in December it is likely going to be June. So I think that's why everyone has this base case. But when you see the kind of CPI print happening in the United States, how difficult does it make that decision?
Well, let's talk about the news conference. In the news conference today, I guess one challenge, and I imagine someone in the news conference is going to ask it, how important is the FX channel to price stability? Because ultimately, this is the question we're asking. If we're going to see the Federal Reserve hesitate, hold, pause, not go anywhere, and the dollar's going to keep on ripping, the euro's going to break down. Jane Foley's joining us later. She's talking about 105. We caught up with Jeff Yu recently. He's talking about parity. They've got to explain why that might not be a problem. That's not an issue, and they can focus on monetary policy in Europe at the ECB.
You know what I'm checking right now? If the euro weakens more, airplane tickets this summer to Europe. And the reason why is because how many more people are going to go to Europe? How many people are going to go buy their goods? How much could this be positives for the nation, aside from just, importing goods at higher prices based on the currency exchange rate? To me, I mean, you have to think it's going to be a boost for people who might theoretically want to fly over there.
You're talking your book again.
No, I'm just saying, I mean, is this not where your mind goes?
My flight's already booked.
Well, this is also why Southern Europe has done so well coming out of COVID. It's the influx of Americans that want to go to Spain or Italy or Greece. I know where you're going, John.
Your flight's already booked too.
Know,
what
whatever.
are you talking about?
Okay, carry on.
And there's a G7 in Puglia if you're interested. Sort of work trip. Do you want to make that happen?
Are we going? Sure.
Try and make that happen. Are you making that happen?
I think I'm close to making that happen.
No, we'll try and make that happen. More US data still ahead. PPI jobless claims 8:30 Eastern time. Investors waiting to see if PPI will confirm yesterday's hot CPI print. Commentary coming later today from the Federal Reserve. You'll hear from Williams, Barkin, Collins, and Bostic all set to speak. I think number one there, Lisa. 8:45. No offense to President Lagarde. I'm going to be listening to John Williams of the New York Fed to work out what he's got to say about yesterday.
Does this change his framework? Does this start to really call into question just how sticky this inflation is? Typically, people listen to 3 people on the Fed. It's typically the vice chair, it's the Fed chair, and it's the New York Fed president. And the New York Fed president, when he comes out and speaks, a lot of people view it as the proxy to Fed chair Jay Powell. If he comes out and he says, this has changed the narrative, we cannot have the justification to really cut rates at this point, that will just solidify this narrative shift that's clearly underway in markets.
Everyone's got an opinion on yesterday's CPI print, including the President of the United States. Take a listen to this.
I do stand by my prediction that before the year is out, to be a rate cut. This may delay it a month or so. I'm not sure of that. We don't know what the Fed is going to do for certain. But look, we have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office.
Fed Chair Joe Biden with thoughts on the Federal Reserve. AMH, what do you think of that?
You think this is a headache for the Fed? This is a massive problem for the Biden administration. Not only does it mean they might not get a cut going into the election, the fact of the matter is it is April, and inflation, this kind of print means this is going to be top of mind of voters going into the summer when we're expecting even higher gasoline prices. And if you look at the items pushing up core inflation, housing, car insurance, clothing, personal care, education, household furnishings, medical care, this obviously is hitting the American consumer, and that is a massive problem for him.
I don't think he was particularly out of line with those comments, just reading them through verbatim, but it's always best, just don't go there. Just don't talk about the Fed and Fed rates.
But this is the reason why they don't want to be cutting rates heading into this election. They don't want politicians talking about them.
Not at all.
They don't want Joe Biden. They don't want Donald Trump. And basically, if they start cutting rates, guess who's going to talk about them? Everybody, which is the reason why it gets a little bit more fraught.
We're all talking about it. Hot inflation prints to start the year, shaping the global outlook for financial markets. Virginie Masseneuve of Allianz Global Investors watching for diverging paths between the US, Europe and China. She sees a more stable inflation picture in Europe and deflation stabilizing in China. Virginie, I'm pleased to say, is with us now for more. Virginie, before we talk about the global backdrop, can we just talk about what happened yesterday? Why the Mag 7 outperformed on a day where bond yields were up by double digits right across the curve? What do you think that was about?
Well, I think it might be positioning of people who are taking advantage of uncertainty if they don't have enough tech in their portfolio. I personally think that, the Max 7 is not particularly where you want to be. Some stocks in there are interesting, but you have to look at tech overall and really bet on quality, strong balance sheet. We still like the infrastructure, the plumbing, building, but also cyber security and the impact, if you want, of technology on the rest of the sectors in digital Darwinism, if you want. So I think on any retreat, you want to add to your portfolio if you don't have enough. But yesterday's move is perhaps a bit of an aberration.
So many people on this program have been hungry for the rotation, been looking towards small caps, looking away from the Mag 7 to other sectors in the equity market, more cyclical themes, looking abroad as well, to Europe, to Japan, and even China more recently over the last few weeks. Do you think that what happened yesterday, the resetting, repricing in bond yields, disrupts that trade at all?
I think it depends on what happens in the future. So I think we are at a crossroad of bifurcating path, if you want. Inflation in the US is more sticky. We've had, leading indication of this happening and growth is very resilient. You have this industrial manufacturing sort of cycle picking up. If you look at PMIs, even in Sweden, if you look at exports from Korea or Taiwan to China, I expect Chinese exports to actually be more healthy than people expect. So you have a pickup in the cycle. If that continues and inflation in the US remains sticky, that's one thing. I think Europe is well placed on the inflation front. And of course, if growth, and that's the second path, if growth actually falters and you have sticky inflation, then this is an environment that's not as positive for the market. So far, I'm still on the first path, but also we have to see what happens with oil prices and geopolitics.
Virginie, you talk about China and investing in China, which is a fascinating trade, and a lot of people are getting on board with this, actually. And it comes as right after that hot U.S. CPI print, Chinese inflation stalled out. And you can see it's moving in the opposite direction. How much is the increasing bet on China almost the diversification? It's the complete opposite story to everything else going on in the rest of the world.
Absolutely, and this is what we've been talking about for a while. The market is very cheap, it's very underowned, and the cycle is very different. We believe that the deflationary trend in China is appeasing, if you want. It's not intensifying. At the same time, we're probably about 2/3 of the way through in terms of the property issues that we have there, and consumption is stabilizing, while I believe exports will be picking up. So an environment where having a position makes a lot of sense.
Well, we see Goldman Sachs and Morgan Stanley raising their outlook for Chinese economic growth. Do you agree? Do you think actually it's going to be higher?
Yeah, I think for the first quarter, we could have positive surprise and it will come mostly from exports. I think beyond that, as long as we have quality growth, I'm happy with it. What we're looking at in China is the power of innovation. So you have the old China, the new China, the power of innovation in tech, in health tech, in infrastructure, et cetera, is actually really fascinating. And I think a lot of people have not looked at it for a long time. There's some really interesting companies there.
Virginie, can we just finish on the United States and the prospect of much more difficult times ahead? There was a belief by some that if we had to delay rate cuts anymore, that ultimately what we were set up for was a hard landing further down the road. Do you think there are risks accumulating, chronic risks accumulating in the system? There's a phrase we hear a lot in credit, which is survive until 2025. Now, I understand a lot of supply came to market to start the year, so maybe we took some bricks out of that so-called maturity wall later this year. But do you think that could be a problem? And where would you be focused on in the economy at the moment?
Okay, so I think it's pendulum swing. Remember, end of last year, people expected 6 rate cuts. We were never in that camp. Higher for longer was always our plan, right, or prediction. I think clearly June rate cut is out of the table, and it will be later. The question is, expectations versus reality. And if you believe that we're on that first path that I talked about, where growth is actually more resilient, inflation is sticky, but it's not going back up. If you look at inventory movements, for example, we've had a lot of the destocking. That restocking or feeding that growth will continue to support growth. I think you're okay, and you will have some rate cut, but it will not be probably what people expected. If you had no rate cut, I think the market is not there to take that scenario into place, and that we could have an air pocket that will provide a buying opportunity.
Okay, Virginie, this was thoughtful. It always is. Thanks for being with us. Virginie Masseneuve there of Allianz Global Investors. Equity futures at the moment on the S&P down by something like 0.25%. Let's get to your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. McKinsey has begun a series of job cuts. The consulting giant has faced a slowdown in demand for services, even after a record revenue last year. The cuts, they hit about 360 staffers. That's about 3% of their 12,000 workforce who are classified as specialists. So this isn't the traditional consultants necessarily. A source says McKinsey's traditional staffers won't be affected. And this is, of course, after McKinsey in the past few weeks offered its UK staffers 9 months' pay to go away. Bad weather looks set to disrupt the first day of golf's U.S. Masters in Augusta, Georgia. Officials announced that the first round will not begin before 9 a.m. Eastern. World number 1 Scotty Scheffler is favored to win his second green jacket, but bad news for Scotty. No favorite has gone on to win the tournament since Tiger Woods in 2005. Now, as for Woods, he said that he is still capable of winning a 6th green jacket and 16th major if, quote, everything comes together. KKR, meanwhile, is weighing a sale of IPO of BMC software that would be worth about $15 billion, including debt. Other PE firms have shown interest in acquiring the Houston-based company. No final decisions have been made, and KKR still favors an IPO of BMC, which filed confidentially last year with an SEC for a listing. Now, speaking of KKR, at 10:30 this morning, Lisa is going to have an exclusive with the co-CEOs. That's your brief, John.
Danny, thank you. Very, very cool. The KKR co-CEO is coming up a little bit later this morning, sitting down with Lisa. Lisa, what's the big focus for you later this morning?
Well, they want to grow to $1 trillion over the next 5 years. But this is what I find really interesting. They don't want to increase their headcount at all. And I want to talk about why. And is this basically a feature or is this a bug? Is this basically an AI improvement story or is it something completely else? And that's, I think, a real interesting focus.
I'll tell you now, it's a theme. It's a theme, that's for sure.
Absolutely.
10:30 Eastern Time. Do not miss that conversation a little bit later. Up next on this program, the ECB rate decision on deck.
We may well see the ECB cut as often, if not more, than the Fed, which was unimaginable a few months ago. I think they're going to signal quite strongly that June is when they're going to cut, something that the Fed will not do.
That conversation up next.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
This is Bloomberg.
Live from New York City, following yesterday's blowout CPI report, 6 basis point upside surprise, just sparking the biggest sell-off worldwide. Amazing. Equity futures negative 1/3% on the S&P. Yield just about unchanged, 453.96. Bramo's got thoughts. I know Bramo's got thoughts. Go on.
Well, I'm just going to say yes, but it was broad-based, and it was outside of energy, and it was the super core. It was everything, and that having 4 consecutive months of 0.4% month-over-month inflation, not great.
Agreed. But it just took that much, right? Just to tip the boat
Yeah.
to the other side.
Yeah, here we are.
Bumps no longer bumps? Maybe. The euro right now, 107.27. Under surveillance this morning, the ECB rate decision on deck.
We may well see the ECB cut as often, if not more, than the Fed, which was unimaginable a few months ago. It is having a huge impact on relative pricing between Europe and the US. And you do see that in the bond market, and you see it in the currency market. I think they're going to signal quite strongly that June is when they're going to cut. Something that the Fed will not do.
Here's the latest. An hour and a half away from the ECB rate decision, officials expected to hold rates steady, but markets are still pricing in a cut in June. David Cole of Julius Baer writing this: we see a good chance that the ECB will surprise with a rate cut at this meeting. The Fed is likely to cut rates as well, but with much less urgency than the ECB. David is with us on a pretty interesting call. David, let's start here. Does yesterday change anything about the way you think about this ECB?
Well, not so much about the ECB, but definitely about the Fed pressure here and more time probably before they cut rates. It might help some council members in ECB and some decision makers also to not see a big urgency of rate cuts. Why? Well, because some of the ECB mentioned that they don't want to be too much ahead of the Fed. But we think that this is a pretty much weak argument. The arguments for rate cuts are more on the fundamental side or more on the economic data side.
David, why do you think it is a weak argument? Just build on that a little bit more. Why is that so weak?
Well, because you see, the argument against an early rate cut would come usually via the exchange rate. When the ECB would really be afraid of a weaker exchange rate, when the Eurozone economy needs to be afraid of a weaker exchange rate. And there we see basically an opportunity to revive Eurozone economic growth, because prices had been rising faster in the Eurozone than in the US, then in Switzerland, then in China. So in all their competitive economies, a weaker exchange rate would help to offset that a bit. The more you surprise actually markets with a rate cut, and the more you are ahead of the Fed, the more you have these effects, which might help to rebalance a bit price competitiveness, which is pretty weak in the Eurozone.
So, David, given everything you've just said, is this a call that you think the ECB should cut rates today, or you think they will cut rates today?
Well, we think they have good reasons to cut rates, and it's definitely more in the camp of they should consider that, they should do that. I mean, all the indications we have and how the Council presents itself to financial markets is that they want to be foreseeable. And of course, when you want to be as a central bank as foreseeable and really guide financial markets, then you won't cut today. We think it's misplaced in this time. We think central banks can really live up to the traditional role of not pre-committed, of not being foreseeable for financial markets, because then they can achieve the best effects for the economy and for the inflation trajectory.
David, if I could just reframe what you're saying, and correct me if I'm wrong, are you basically saying that the euro economy needs a weaker euro right now to basically fight the fact that prices have been going up, that they're dealing with nearshoring, that they're dealing with Chinese competition, and they're trying to revive their manufacturing sector?
It would be more helpful than doing some harm. You know, when you are a central bank and you look at the exchange rate, you have two effects. One is probably reviving economic activity when really price competitive needs that. And here we see a tick. We think, yes, this is now the case in the Eurozone. And then you might be afraid that the weaker exchange rate really increases again your inflationary potential, your imported inflation. But right now, when we see like the inflation rate, and when we look at the components, and it's most the domestic-driven sticky inflation, which is keeping inflation away from moving more strongly to 2%. It's not the imported inflation. We don't have the supply chain issues which were driving inflation 2 years ago. That's why we think, on balance, it's quite a good idea now to rely on exchange rate to revive economic growth without having really much negative effects on the inflation trajectory, on the inflation forecast for the Eurozone.
Before the show, we were asking, John asked you about yesterday's CPI print in the U.S., and you said, I believe that was the U.S., and that the ECB has a meeting today, and basically you're completely separating the two. Is the divergence of the central bank activities a feature and not a bug, based on what you're saying with the currency backdrop?
It is definitely a feature, and it's not only central bank activity, which is different. It's really the demand backdrop. U.S. is still having strong demand of economic growth, and this shows up in quite robust economic growth. The Eurozone basically is stagnating in terms of GDP since 1.5 years. So there is a huge difference in the fundamental backdrop, which shows up also in inflation and inflation expectations. And we simply think that central banks should acknowledge these different developments and act accordingly.
What do you make of the euro-dollar? Derek Halpenny pointing to 105. You have some people calling for parity. Where do you see this pair going, given the latest data we've had coming out of the United States when it comes to CPI?
Well, again, like for probably regarding fundamentals, the divergent fundamentals will probably not be enough to drive the euro significantly lower. You need also the acknowledgement of central banks and central bank policy. So we think that when the ECB indeed listen to the fundamental data and surprise financial markets here, then we can see that probably the euro drops out of this trading range. It had been pretty stable in the last year in a trading range. It drops out of the trading range and goes really below the 105 and really in the direction of parity.
Certainly wasn't stable yesterday, that's for sure. David, thank you, sir. David Cole there, Julius Baer, with some thoughtful stuff on the ECB, reasons why they should be cutting interest rates today. We'll get that rate cut call at 8:15 Eastern Time. Consensus view, the consensus view is no rate cut today at all. This from Kit Jukes of SocGen this morning. As the saying goes, if it looks like a duck, swims like a duck and quacks, it's probably a duck, or in this case, a problem for dollar bears, bond bulls, and the FOMC. The question we're asking, is it a problem for the ECB and the BOJ?
Or is it actually a feature for the ECB? And this is kind of what we heard from Jeff Yu earlier, and this is kind of what we just heard there from David, this idea that they want a weaker euro to stimulate their manufacturing industry, as well as, I mean, it's been stimulating the tourism industry for quite a while. This, to me, is one of the key questions. How far can that go? And is this divergence going to be okay for a little bit, but not too long?
107.29. Jane Foley coming later, looking for 1 0.05. Coming up next to the second hour of Bloomberg Surveillance, we'll catch up with Katie Kaminsky of Alpha Simplex, Henrietta Trace of Vader, Maryland Governor Wes Moore, and Ian Lingen of BMO. Katie Kaminsky coming up in about 5 minutes' time. And Bramo, short treasuries before, and I imagine more reasons to be short based on what we've seen.
Yeah, she tried to go long for a hot second, and then she said, this is really difficult, no way, and got ahead of this move. Key question here is, what's the next step? We heard a lot of people overnight talking about 5% 10-year yields, the sky's the limit. Is this people just getting over dramatic because, it seems like something that everyone is doing, or is this something that has legs?
Don't you like how most people in fixed income appear just to be momentum traders? They come on and they say, yeah, it's going to be a buy when it backs up to 450. Where are all the headlines? Where are all the notes of people screaming buy, buy, buy with a 10-year back at 450?
The problem is, this is such a hard market to call. I know I sound like a broken record, but what conviction can you have when people can't agree on what the terminal rate is?
450. 450.
Are you trying to sell something?
No, I'm just saying that this is
450.
what everyone wanted.
Where were you yesterday at 1 p.m.?
Right now, the 2-year.
Where were you? They could have used you.
Where were you at yesterday's auction?
I thought you were doing it.
The 2-year.
450.
496.
451.
I do the auction.
452.
That's why I can't take you Mitch's calls.
Oh.
Because I'm busy in the afternoon
is that
doing
really
the bond auctions for Treasury.
Well, I should call you.
That's what I do.
Well, yeah,
everyone
who knew?
knows that.
I thought you would care more about it then. Come on.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm gonna get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean,
Connection lost.
He wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. He has mercy. The other one has no mercy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Inflation will be sticky, but that shouldn't stop the Fed because the 2% inflation target is too tight.
They've created a financial market environment that's much too accommodative
for what their desire to cut rates are.
I think that this lack of stability is going to be with us for a while, and I don't think that they have a clear strategy for how to manage it.
Frankly, even if they cut this year, is not going to be as relevant as whether we are indeed in a soft landing.
The sound that you heard there was the door slamming on the June rate cut. That's gone.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The door slams shut on a June rate cut, and Wall Street is playing catch-up big time. Some big shifts in the last 24 hours. Talk about market to market. Goldman Sachs, Jan Hatzius, shift their call from June to July after shifting it from March to June. Steve Englander over at Standard Chartered go down from 4 to 2. Everyone's had to make some big changes, including everyone in fixed income. Check out this board now, the 2-year, the 10-year, the 30-year, with some brand new numbers for 2024. 495.45 on a US 2-year, on a 10-year, Lisa, a clean break of 450.
You talk about the changing narrative and the revisions across Wall Street, and the yield space right now speaks to revisions not only on the front end, on this idea of when the Fed can cut, but how far the Fed can cut rates. You mentioned Stephen Englander. Not only did he revise his Fed forecast in the near term, but he said we now expect the trough of the Fed funds target to be 350 rather than 325. This is an entrenched feeling that inflation is going to run hotter for longer, and that's what the market is really trying to come to terms with.
That's the direction of travel, has been now for the last 4 months. It just picked up big time in yesterday's session. It was a big question of when, not if, and now apparently it's if, not when.
And I think we have to wait for that PPI report to finally be the final nail in the coffin for some of these individuals betting when the Fed is going to cut rates. I look to Morgan Stanley's Ellen Zentner. She's basically saying the June rate cut is in jeopardy. It's on life support. And she says, dependent on the PPI data, this print tilts the Fed toward a later start in the cutting cycle. So let's see what PPI comes in, but pretty much everyone is expecting we're all in towards the end of the year.
8:30 Eastern time for PPI, together with jobless claims. The estimate for jobless claims, 215. The previous week, 221. Tons of Fed speak as well, including New York Fed President John Williams. Now, New York Fed President John Williams, you remember back in December where he poured cold water over the December rate cut conversation, which was sort of engineered by his boss, Chairman Powell, in the news conference that month. I wonder what he's got to say later on today.
If you think about it, taking a step back, some people say this is all the Fed's fault. Because, of course, they say that because they're always going to blame the Fed no matter what happens. But people saying that the change in communication materially loosened financial conditions at a time where inflation had not died. And that actually financial conditions are easy, not because of rate policy, but because of jawbone policy. And so how do they jawbone policy a different kind of message, right? How do they sort of give communication that counters the narrative in the market without totally undermining any credibility that they have left?
Those words reminded me of what we've heard repeatedly from Torsten Slock over at Apollo, who has said that the easy financial conditions have been a factor. We can talk about how big a factor, but a factor in what we're seeing. This was a quote from him yesterday. 3-month annualized change in supercore inflation, now over 8% and accelerating. 6-month annualized change is 6%, and the year-over-year change is 5%. We're sticking to our view that the Fed will not cut rates in 2024. Is he finding more and more company as we get more and more data?
Without a doubt. I mean, the market basically confirms that. We're seeing now just 2 rate cuts being priced in, and tepidly at that, not even. There is this question of what we could be missing. And of course, Steel Dutta on Q yesterday came out and said, just quit it, guys. We are seeing disinflation. Check out wages. If you look at the Atlanta Fed wage tracker, you do see that. People point to quits, people to point to small business optimism falling off a cliff. There are reasons to see this. The problem is, how much can the Fed really justify making a shift, given the hot inflation reads, the strong labor market prints, and the political backdrop that really creates a fraught situation?
I'm glad you brought up the political backdrop, because Paul Donovan at UBS is talking about actually they are seeing deflation in every consumer price prospect, but in certain states. He points to clothing prices in Tampa. He points to plunging communication prices in Chicago. It's difficult to argue, he says, that structural inflation stickiness exists when every key sector has deflation, but somewhere in the country. This is what makes it so complicated.
The PPI, jobless claims coming up a little bit later. Equity futures right now on the S&P 500, negative 0.25% on the S&P, just a little bit softer after yesterday's big sell-off. Bond yields just about unchanged, 454.57 on a US 10-year. In the FX market, the dollar stronger against everything yesterday, just a rip-roaring rally against the euro this morning, stronger again, 107.30 ahead of the ECB. Coming up this hour, Kenny Kaminsky of Alpha Simplex on the risk of even higher inflation inflation still ahead. Maryland Governor Wes Moore on rebuild efforts in Baltimore, and Ian Lingen of BMO following the biggest rise in 10-year yields since 2022. We begin with our top story, a bump in the road or new terrain. Investors closing the door on a June Fed cut following another hot CPI print. Katie Kaminsky of Alpha Simplex warning of even higher inflation ahead, writing this. The real concern is future CPI prints given current commodity trends. Should the inflation data start to pick up further, we could see potentially even higher rates in the short term. Katie's with us now for more. Katie, I want to understand what things looked like for you yesterday. Do you and the team just sit there smiling, watching yields rip and the dollar rally?
Well, the truth is short signals have been very consistent this year. They haven't really sort of come to fruition because they've been anchored on a dovish Fed. But what is happening now is the breakout that we've been looking for in fixed income, which is basically identifying that there is more inflation than people would like, and that inflation is going to be harder to get lower. The biggest thing I've been watching before yesterday was commodity prices. Take a look at precious metals, industrial metals, and energy. They have already started to move substantially before this event, which is going to be a tailwind for a better inflation number in the future, which means we're here for longer.
You were short bonds into it, and I think that's the question, why you should stick with that trade for longer. Can you build on the signal coming out of the commodity market? And I want to introduce crude as well, $90. What gives you the impression that these kind of levels in commodities are sustainable and they'll carry on driving these moves in fixed income?
Well, if you look at where some of the commodity prices have moved, it's been substantial. Take a look at copper. Take a look at gold prices, and we can talk about that in a minute because it's a little different, but also energy. And when you see how much those prices have increased in the last 6 weeks, we've also seen some of the disinflationary pressures that we saw in agricultural sectors dissipating and bottoming out somewhat in February. This means that a lot of these disinflation trends, and in fact now uptrends, are starting to be visible in some of these raw commodities, which tend to be sort of the leading indicator to issues that we see. This is exactly what we saw in 2022 when we saw such a high inflation print later in the year. So there is some concern that this is going to be a tailwind for the narrative of the future CPI later this year as these prices put pressure through the system.
We've been talking a lot this morning, Katie, about where the bond market moves have really been coming. It's been interesting on the short end, makes a lot of sense, pretty directly correlates to Fed policy. The long end is really the confusing part for us because we are seeing people reset longer-term inflation expectations. Where are you most short? Are you seeing some of these shifts in momentum in the long end with the idea of people really questioning whether this Fed has the conviction and the will to bring inflation lower in light of some of the commodity and industrialization moves?
Well, signals across the bond curve technically are still short across the curve. A little shorter, stronger on the short end, but there's still really a lot of concern for long-term bonds. And the concept of this is very straightforward. If inflation remains sticky, then there's a chance that really sort of owning long-term bonds could potentially really have a deterioration in value. Should we stay sticky in inflation? Or should we cut and then not need to, and thus those bond prices in relative terms with inflation sticky become vulnerable? So I think a lot of people are not thinking about long-term cash flows are actually quite vulnerable to a sticky inflation and longer-term inflation expectations, which means that there's still definitely downward pressure in those markets.
At the same time, you have people who say, look to recent history. Every time yields got to a certain point, it brings the buyers in. We've heard buyer after buyer, potential buyer after buyer, talk about how it looks really attractive to lock in yields at this level. What are you seeing on the technical level about whether people are lining up to buy at certain levels or whether that bid has evaporated along with the narrative?
Well, this is not a conversation I'm seeing right now because I think people need to have more clarity on how long it's going to take to cut. So if they really did believe that cuts are coming sooner rather than later, then you would definitely expect that people want to get in and lock in those higher rates today. But given all of the commentary about inflation, stickiness, and sort of the long-term battle that we have ahead of us, it's still really unclear at what point we're going to get that buy signal. I know we got it in October when we saw a 5% 10-year, but we're still really far from that 5% at this point. So maybe 5% is that point where people start to say, there's no way we're going higher. But it could still be a case, like I said, that we had a big steepener where people are concerned about even higher inflation. That's a rare event, but it could happen.
Katie, you name-checked gold as a little bit different than the rest of the broader commodity space. On this program, we've heard people talk about sanctions policies, geopolitics, inflation hedge. What do you give this gold resilience to? What does it come down to?
For us, I think it's really about real rates. And that's actually something that's been very interesting to me for the last month. Gold prices have gone way up. And so if you take this very simple analogy, if you were, say, for example, going to buy your S&P with gold, actually, in some sense, the S&P hasn't gone up in real terms. So that's something that we have to think about in an inflationary environment, that if we have some inflation is good for equity nominal prices, but the fact that gold prices have increased so much suggests that real rates are not as attractive. So people want to actually have gold as a store of value. So in gold terms, equity markets are actually gone down in value. So if you kept your gold at home, you could actually buy more S&P.
Katie, gold's really confused me, and you've confused me there too. So I'm going to have to go back to those comments and listen to them twice, maybe 3 times. Katie, can you explain really clearly what on earth is going on with gold and its relationship to bond yields? Because for most of this year, over the last couple of months specifically, gold's rallied, yields have climbed. Odd relationship, but it's been developing. Then yesterday happened. Yields ripped, gold dropped on a hot inflation report. Katie, what's that about?
That's a trickier one because that's a one-day move. I'd say that the more recent move to us has looked like decreasing real yield. So if you have inflation increasing, you want to hold gold as a store of value. On the other hand, when you have the situation like yesterday, it may be the case that people see it as an opportunity to take profit in gold. I'm not sure, because yesterday was definitely a very idiosyncratic day. But in general, gold has been increasing as a safe haven asset where people are thinking about inflation potentially ticking up as something where you want to store value. And that's why it's interesting that the S&P relative to gold hasn't really increased.
Yesterday wasn't a one-day move, it was a one-year move in the bond market, Katie. Katie Mincy there of Alpha Simplex. Katie, thank you. Short fixed income, short bonds, and let's face it, after yesterday, right to be. Lisa, looking at gold this morning, positive by 0.2%.
You pointed to yesterday's sell-off in gold. Just want to point out Bitcoin was up, just theoretically. I mean, one day to move isn't going to do anything, but I do wonder if the sort of new trade that's developing is short bonds, long gold. Basically, if you believe inflation is going to tick up and suddenly we're going to talk about the deficit and all that, the auction yesterday, go forward, go crazy. But this question of whether gold is sort of the new ballast and the new haven on the margins, given central bank buying and other concerns, bonds not so much.
It's hard to keep up, that's for sure. 8:30 Eastern time, more to talk about. We're going to get data, PPI, jobless claims as well. 8:15, so 15 minutes before that, you get an ECB rate decision. 15 minutes after that data, so 8:45 Eastern time, you'll hear from President Lagarde. And at the same time, you should hear from John Williams of the New York Fed as well, with some comments, hopefully, on yesterday's data. Equity futures negative here by 1/3 of 1% on the S&P. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Allianz's chief economist Ludovic Sabran says the ECB is now in what he calls a pickle, now that the Fed cuts are likely to be pushed out, widening rate differentials between the two.
The sensitivity is the following: 100 basis points difference on the interest rate differential is 4 to 5% depreciation on the euro dollar. Markets could be spooked that the ECB threw the baby with the bathwater a bit early.
Sabran spoke to me earlier on the Bloomberg Brief, which you can catch every weekday at 5 a.m. A who's who of business and tech leaders gathered at the White House last night for a state dinner in honor of visiting Japanese Prime Minister Kishida. Jamie Dimon, Larry Fink, Tim Cook, Jeff Bezos were all among the high-profile attendees. There are also some celebs. Robert De Niro and Olympian Christy Yamaguchi were also in attendance. U.S. credit card delinquency rates were the highest on record in the fourth quarter. That's according to a report from the Federal Reserve Bank of Philadelphia. Almost 3.5% of credit card balances were at least 30 days past due as of the end of December. That's up by 30 basis points from the prior quarter. The number of debts that were 60 and 90 days late also climbed. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, antitrust action heating up over U.S. steel.
I stand by my commitment to American workers. I give a man of my word, I'm going to keep it. And with regard to that, I stand by our commitment to our alliance.
We'll follow that story next on the program, live from New York City this morning. Good morning.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Earnings season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
Equity futures on the S&P 500, negative here by a third of 1%. Yields up again, nothing like yesterday, let's be clear. Up a single basis point today. Double-digit moves yesterday right through the curve. 455.59 on a US 10-year. Under surveillance this morning, antitrust action heating up over US steel.
I stand by my commitment to American workers. I give a man of my word, I'm going to keep it. And with regard to that, I stand by our commitment to our alliance. This is exactly what we're doing, a strong alliance as well.
Here's the latest. President Biden pledging his support for American workers as the DOJ opens an extended antitrust probe into Nippon Steel's bid for U.S. Steel. At a meeting with Biden at the White House, the Japanese Prime Minister weighing in on the deal, saying, quote, Japan believes that the U.S. government will proceed appropriately and in accordance with the law. Henrietta Trays of Vader Partners joins us now for more. Henrietta, can you just walk us through how thin this tightrope is for the President of the United States on these issues?
That's a fair way to say it. I would maybe encourage people to think of how long that rope is. I would imagine it goes all the way through the November elections. Ever since this deal was announced, there was immediately to my mind an understanding that this is going to take a very long time. There's no reason that this has to be approved before the election. I do think that, to acknowledge your point about how tricky a tightrope this is, they really just need this to be thoroughly vetted, dot all the I's and cross all the T's, but very likely it will take well into the fourth quarter of this year. And I suspect after the election, there's no reason to inflame risk or risk any tensions from either side. I think Nippon Steel can be patient, and I think the DOJ is going to do a very thorough accounting of the entire situation. So I expect this to take a while.
In some ways, they're lucky that this is Japan, because Japan has been very respectful, very aware. They know exactly what is going on. This is about November, so let's talk about November. Is it working? When you make moves like this, or suggest you will make moves like this, to attract the vote in places like Pennsylvania, there are signs that this is beginning to work.
The way I think about the election at this stage, when we're really in the heart of it, is you're trying to see an absence of unforced errors. So former President Trump came out aggressively against the deal, and President Biden is not going to give him an inch of any kind of wiggle room to either tack further to the right or hard line on trade with him. This administration has been very conscientious of where the Trump administration in 2017 took us on trade. All the existing tariffs on China, for example, are still on. The Section 232 steel and aluminum tariffs have been suspended, but they're still in existence. So there's this weird nexus of the world where Democrats and Republicans under President Trump, former President Trump, have sort of overlapped a lot on trade. And I think they're both making very similar points. And it's one that Democrats feel very comfortable making. And former President Trump is trying to sort of outflank throughout this process.
Your base case is that Biden will win another term for the White House. Yesterday, we had hotter than expected CPI, a lot of concerns about what this means as voters head to the poll. It's still one of the top concerns when we go out, when Gallup goes out and takes these surveys. How do you see the president potentially shifting in how he talks about the economy? Because it's not working.
Yeah, it hasn't worked all year, despite the fact that the economy has improved and CPI has come down substantially since the midterm elections. I think what I would encourage folks to do, and I just published a report on this, is look historically at what voters say they care about. It's consistently the economy. In this point, the economy and inflation in your polling is 31% of the population's #1 issue if you combine the two of them. The issues are tremendously important, of course, especially at the household level and amongst female voters in the United States. They have a 10% more negative view of the state of the economy than male voters do, perhaps because they're more exposed to making household purchases. And obviously gas prices continue to be an issue going into the summer months. But look at what happened in 2022, for example, and 2023. Even when inflation was at 9% in the run-up to the election, who won the election? Democrats across the board. And that was in the Senate, where they picked up a seat despite having majorities in the House, Senate, and the White House. President Biden's approval rating was through the floor. It was, completely underwater. And voters still gave the Republican Party the worst showing of a minority party since the 1930s. So the question you have to ask yourself is, when voters say the economy and inflation are their #1 issues, just like they did in 2022, how do you justify then them going into the ballot box and pulling the lever for Democrats, which they've done consistently from Ohio to Kentucky, just as recently as 5 months ago? And so while immigration and now crime and sort of terrorism are top issues amongst Republican voters, what we see time and again, and specifically just 5 months ago in the sort of first in the nation votes on the 2024 election in Ohio and Kentucky, as well as Virginia, is that abortion is the, in fact, driving motivator in getting people to the polls. And when they go to vote on anything, when they get in the ballot box, they pull the lever for Democrats. And I suspect it's largely for abortion. So the rulings on IVF in Alabama, the 6-week ban from the Supreme Court in Florida, the new ban from the 1800s in Arizona, which was just upheld last night by the Republicans in the House and Senate there, are the real problem. And I think a real factor in the election, more so than the economy, because people, it's sort of nebulous to say, I'm voting on the economy. You really go in and say, what do I have to actually change? What does my vote impact? And it's abortion.
So it's almost like a protest poll. I'm fed up with these gasoline prices, and I'm fed up with what's going on in the grocery, but then you go into the polling booth and you're like, actually, what matters to me most is abortion. In that sense, then, what's going on in Arizona, does that shore up the Democrats can control that Senate seat? Because when it comes to the Senate, the Republicans really have an advantage.
When it comes to the Senate, Republicans are in a position of extreme strength, both geographically and statistically. All 8 seats that are even worth monitoring right now are Democratic seats that Republicans are putting up real fights for in mostly purple and even red states. I mean, Democrats have no business winning 4 election cycles in the Senate in Georgia in the last couple of years, let alone Arizona and keeping Nevada. I mean, those states should be Republican, but they're not. And I would say that there's one reason for that, and it's ever since 2016, it's Donald Trump and it's abortion, and they lose every time.
And you can see how it's becoming a bigger problem for them. Henrietta, just President Trump and how Carrie Lake even have responded to that decision. How are they responding? How are they messaging to the electorate?
Arizona is such a perfect encapsulation because we have Ruben DeLeo, who's even more progressive than Joe Biden. We have Carrie Lake, who's a perfect proxy for Donald Trump in the MAGA universe. And then we have Kyrsten Sinema, who I think is a great proxy and stand-in for Nikki Haley. And you're seeing the trends in that state consistently outperform Biden and Trump at the top of the ticket, with Ruben DeLeo outperforming in fundraising to a much greater extent. Carrie Lake is trying to distance herself from her historical statements on abortion. She used to be a strong proponent of exactly the law that was passed, or excuse me, the Supreme Court decision. And now they're sort of trying to backtrack. But to get back to the original point about unforced errors, if the former president's going to come out and say, I support states' rights, and then the state goes and acts the next day, this is exactly what he said he supported. So it's really hard to distance yourself from it. And I think you're going to see that in the polls in the next couple of weeks.
Seeing a lot of it. That's so well framed. Henrietta, thank you. Henrietta Trace there at Vader Partners. Arizona's fascinating right now, seeing how this is playing out.
And also, they had a potential incumbent when it comes to Kyrsten Sinema. She decided to become an independent, and she's not running. It's very fascinating. And what's happening in abortion, I mean, this law was on the books before Arizona actually became a state. And what's happening there has the Republicans scrambling. And potentially, this could give the Democrats not just a seat, but Biden the presidency.
We support state rights, but just not state decisions like those. Seems to be the theme.
They put themselves in this box, and that is the problem. And how do they get out of it? How do they communicate? Because we know that Donald Trump and Republicans, they struggle with women and suburban women. And you see a ruling like this, and this is very unnerving. And even if they're annoyed with grocery prices, 10 point, they'll go vote on abortion.
Big focal point going into November. Equity futures right now on the S&P 500. If you are just joining us, welcome. A little bit softer here. We're down about 1/3% on the S&P. Coming up next on the programme, Baltimore hoping to have its port fully restored by the end of May. Maryland Governor Wes Moore joins us next from New York City. This is Bloomberg.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
And pause. Yesterday was like a week, a year's worth of price action in the bond market. Look at things now, softer again on the S&P. We're negative 1/3% on the NASDAQ. We're down about 1/4. We're down 0.7% on the small caps. The small caps yesterday getting absolutely hammered. In the bond market, if you were away from the market yesterday, this is a big reset for you. Totally different numbers. The 2-year with a move of about 20 basis points, 496.30. Yields a little bit lower this morning by a single basis point. The 10-year with a big adjustment as well. We're talking about double-digit moves right the way through the curve, 2-year, 10-year, 30-year, and we're talking about new highs for 2024 as well. 455 on the 10-year. Lisa has talked a lot about auctions. Yesterday was a really sloppy one. And a little bit later, Lisa, the 30-year bond, $22 billion worth this afternoon.
At a time when people can't really put a finger on what inflation is going to be over the longer term, because yesterday wasn't just a reset about Fed policy. It was a reset about how sticky this inflation is and what that means longer term, which is why you had dealers taking up the greatest amount of yesterday's 10-year auction going back to late 2022. Do you see a repeat of that as people really push back and say, wait a second, we have to rethink exactly what levels we're looking at longer term?
Possibly a reset in foreign exchange as well. So let's switch at the board and get to FX and start with the euro. The euro breaking down to about 107, 107.31 later on this morning. So about 45 minutes from now, we'll get an ECB rate decision. That's a weaker euro, a much stronger dollar in the last 24 hours. And even for dollar yen, for the Japanese, for the Bank of Japan, we were talking about 152 as the line in the sand. Forget 152. We cleaned out 153 in the last 24 hours.
And this isn't something that Bank of Japan or any Japanese officials can really easily fight against, because it really is just a fundamental shift. This is the dollar ripping at the greatest pace yesterday since the banking crisis back in March of 2023. So at what point do central banks welcome this? And at what point do they just sort of accept it? And how much do they try to fight it?
The dollar stronger against G10 in a big way. Under surveillance this morning, a fresh read on the US economy coming in just under an hour with PPI and jobless claims at 8:30 Eastern time. That'll be followed by a slew of Fed speak. We'll hear from Williams, Barkin, Collins, Bostic, all on deck, and you'll get a lot more going into the weekend as well. It's Williams for me, Anne-Marie. I think that's got to be the focus of the big three on the FOMC, the New York Fed president, his thoughts on what happened yesterday morning.
And what does that mean in terms of the path for the Fed, and how many rate cuts is the market right when they're starting to say, actually, it's going to be 2 or maybe even less? We heard from Barkin yesterday. I loved what he said. He said, quote, "We're making a lot of progress. We need to be humble about how easy it is to get there." So the Fed wants to be a little bit more humble. And Steve Rasciuto yesterday, for me, hot landing. That's what he calls this is. And whether or not the Fed, and potentially we'll hear that today from the New York Fed president, whether or not they're going to have to accept a 2 to 3% inflation landing in order to cut rates and continue the economy moving.
That's definitely been a theme through the pandemic and coming out the other side of the pandemic, humility, that we all need a dose of humility. Very, very unsure as to what is happening in the economy and what is happening in markets too. So we spent the last couple of weeks talking about a big rotation in markets to small caps, away from mega cap tech. What happens yesterday? Small caps get hammered. Mega cap tech, the Mag 7, they do okay. More on mega cap tech. Amazon, the CEO Andy Jassy has just published his annual letter to shareholders, expecting the company's cloud infrastructure to become an essential part of the generative AI boom, saying, quote, "Much of the world-changing AI will be built on top of, guess what? AWS." So I guess the shareholder letter this morning, Lisa, is a pitch to investors to buy, because this is where it's going to be for AI.
It's a pitch to investors saying, stop telling us that we're losing the race with Azure of Microsoft. We're not. This is absolutely in our repertoire, and we're doing just great. Whether people buy it is another question, but it shows where the race is. It is in terms of consolidating cloud ownership, in terms of the AI space, and dominating it in a way that Google's having a lot of trouble doing.
But this also follows his letter last year. He talked about how they want Amazon to help fuel the artificial intelligence, boost efforts to develop and build Amazon franchises, groceries, health, et cetera, et cetera. It's basically the same thing, but revamped and a lot more fuel to that fire.
Amazon just a little bit softer in the pre-market. Let's turn to our next story. The NTSB said its investigation into last month's Baltimore bridge collapse is honing in on the vessel's electrical system. President Biden saying the federal government will pay for the bridge recovery and rebuild. Meanwhile, the governor of Maryland saying he hopes to restore full service at the Port of Baltimore by the end of May. I'm pleased to say that with us is Governor Wes Moore. Governor, thanks for giving us your time this morning. I know it's been a very difficult month for you and the people of your state. Very, very difficult. I want to start with this because the President of the United States, President Joe Biden, has committed to funding the cost of the rebuild. How confident are you that he can get that financing through Congress?
Well, I'm confident that it's imperative that we can get it done. If you look at the economic impact of the Port of Baltimore, the Port of Baltimore is worthy and contributes about $70 billion to the American economy. The Port of Baltimore is the largest port in this country for new cars, for heavy trucks, for agricultural equipment, for spices and sugars, for coal. That a huge chunk of the American economy relies on the Port of Baltimore. And so I'm thankful that the president has led and rightfully acknowledged that what happened last week was not just a human catastrophe. I mean, we lost 6 Marylanders. during this catastrophe. And it was not just an economic catastrophe for Maryland or for the region. This was an economic catastrophe for the country. And so our ability to be able to rally in a bipartisan fashion and to be able to get the port reopened and reopen the and get the bridge rebuilt is going to be a national priority.
So two issues there. So reopen the port and reopen the bridge. Can we deal with the first one first? Reopen the port. How straightforward is that going to be?
This is a remarkably complex operation. We've never had a maritime disaster like this where you have not only a ship, a vessel, that's the size of the Eiffel Tower and the weight of the Washington Monument that is now stuck in the middle of the Patapsco River. And part of the reason that it's stuck in the middle of the river is because it has a bridge, an iconic bridge, that's sitting on top of it. 3,000 to 4,000 tons of steel are sitting on top of the bridge, and the remainder of the bridge is sitting at the bottom of the river. So this is still a remarkably complex operation, one where we have our divers who are in there every day, and they literally cannot see anywhere between a foot or two in front of them because of the amount of wreckage that's in the water. And so the ability that we've now been able to open up 2 channels that can now have up to a 14-foot depth, so you can get certain commercial vehicles. We've had 59 commercial transfers that have already taken place, and hopefully by the end of May we'll have fully functioning operations for the port. Is a staggering accomplishment when you think about the speed and the coordination that was required in order to make that happen.
So end of May for the port, Governor, but what about the rebuild of the bridge? What does this timeline look like?
The rebuild of the bridge is going to be a longer timeline. The thing that we know is for that bridge that over 36,000 people went over that bridge every single day. That was the bridge that got people from where they lived to where they worked, from where they lived to where they worshipped, to where they lived to where they went to school. It was also a key and a crucial part of port operations because for the Port of Baltimore, it's not just maritime operations, it's also rail and it's also truck operations that exist in the Port of Baltimore. And so in order to truly get the Port of Baltimore up and going in the same kind of fashion that it was before, getting that bridge rebuilt is going to be imperative, and we know that's going to be a longer timeline, but we are committed to making sure that we get the key bridge rebuilt.
And I know that's why you're going to be in Washington today to be speaking to lawmakers about the funding to rebuild this. I was struck by what Senator Cruz said yesterday. He says that he wants to get this rebuilt as soon as possible, but he said it's bureaucratic dithering and lengthy environmental reviews, kind of blaming it on Democrats for this bureaucracy, environmental reviews that could potentially make this a long-term process and not as quick as, say, you and residents of Maryland want to see. Do you agree with him that this should be really fast-tracked?
Well, I'm thankful that Senator Cruz is a yes on making sure that we can get 100% funding for it. And I'm thankful that Senator Cruz understands how imperative it is that we both get the port reopened and also get the bridge rebuilt. I also know that the White House, I mean, I had my first phone call from the White House at 3 o'clock in the morning of the tragedy. And the White House has been with us every single step of the way. The Secretary of Transportation was literally down there, boots on ground before noon, to be able to assess the damage and assess what they can do to help. I have yet to receive a phone call from Senator Cruz. I've yet to receive a visit from Senator Cruz. I would welcome him to come to Baltimore for him to see exactly the circumstances and the situation that we're dealing with. And I'm sure when he came, he would also see that there are members of the Biden administration who have been on the ground the entire time, and I'm sure he would spend time with them as well when he came to Baltimore. I know this needs to move quickly. This needs to move fast. We need to focus on safety, and we've got to get this thing rebuilt. And I'm glad we are building a bipartisan support structure around what it's going to take and around what that can look like.
You talk about how quickly it's important to rebuild the bridge, and I know a lot of people would agree from every facet of the region. How much are you exploring other types of financing if it doesn't come from the government, whether it's issuing municipal bonds or getting public-private partnerships?
I think that all options should be on the table, and all options are on the table. You know, I don't come from a political background. I'm frankly an Army guy. I was a paratrooper with the 82nd Airborne Division, and then when I left the Army, I started a business. So I understand the role that the public sector, the private sector, that philanthropy is also going to play in this. And even if you just look at the past week, you know, we've used every lever at our disposal to be able to address this issue. I actually issued an executive order that released $60 million of state funding that went towards supporting our port workers. We actually signed legislation that focused on things like providing scholarships to the children of transportation workers who have died on the job, and also providing additional supports for businesses. We also helped launch something called the Maryland Tough Baltimore Strong Alliance, which is over 80 organizations, private sector, businesses, and philanthropy. We've now raised over $15 million that's going towards port workers, and also have a commitment from businesses to do things like they're not laying off their workers. If they have to temporarily move operations from the Port of Baltimore, they're going to bring them, they've committed to bringing them back to the Port of Baltimore. So we know it's important to use every single lever at our disposal, and that every sector, private sector, public sector, philanthropy, have all got to be involved and at the table in order for us to get to our long-term conclusions.
Well, as a Marylander, as a business owner, as a military man, you fully understand the importance of infrastructure and what the ramifications could be the longer that this goes on. Is there a drop-dead time where, say, it takes 2 years and that's the maximum that it could take to rebuild this bridge and get operations, to reopen the port, to get things back up and running, where Maryland, Baltimore can withstand that, versus after that, where it becomes a real financial weight that has much more punitive consequences?
Well, it's a financial weight now, and it's the reason that we are moving as fast as humanly possible. It's the reason that we have 24/7 operations that are going right now, and that cadence, that speed, it's not going to stop. I'm committed to making sure that we are moving with speed on this, because we have to remember there are tens of thousands of port workers that right now are being impacted by this. There are entire communities that now have watched their way of life completely upended. There are industries that the country relies on that are now at either a stop or a stall because of what has happened with this port tragedy. And so, you know, the how imperative it is that we move fast on this, it sits with me every single day. And I know we are going to, and I'm going to demand 24/7 operations until we accomplish 4 goals. Bring closure to these families, reopen these channels, make sure we're taking care of our people who've been impacted by this, and getting the bridge rebuilt.
Governor, how much money do you need?
Well, the truth is that we don't have an official price tag on that right now. That we know this is going to be a long journey. We know this is going to be something that is expensive. We also know, though, taken place thus far. If you would have asked me 2 weeks ago, seeing what I saw, and said that 2 weeks later we would have 2 commercial channels open, that by the end of this month we should have up to a 35-foot depth in draft, that should be able to get a lot of the new cars and roll on, roll off that the Port of Baltimore relies on up and going, and by the end of May we should have the port fully functioning. I would have said, when you look at the damage and the devastation that we saw, I would have said that seems very ambitious, but that's where we are. And so we know this is going to be a long journey. We know this is not going to be an inexpensive journey, but it's a journey that we all have got to be committed to, because this means everything to not just our region and our state, but to the long-term growth of maritime operations in the American economy.
Governor, we appreciate your time, and I know this is going to be a long road ahead for you and your state, and it's going to be an ongoing conversation, and hopefully we can talk to you again in the future. Governor Westmore, thank you, sir. The governor there of Maryland, difficult conversation, difficult time for his people in that state after the Baltimore Bridge collapse. Bramo, it's important to ask, how much money do you need? I'm not expecting a precise figure. I need $2.whatever billion, but if you go into Congress, they're going to want to know, what's the price tag?
And to understand exactly how it's going to be deployed. I mean, when you started talking about how challenging it is to move something that's equal to the monument or the Statue of Liberty or the Eiffel Tower, and you've got steel over it. Here's the issue, though. At what point does some of the dock work move away from the region? At what point does the traffic push people away from living in that region? There are all of these longer-term implications that go on the longer it takes to really rebuild.
We have at least a timeline on when the port will be fully opened, the end of May, but no timeline on how to rebuild this bridge. And Jonathan, to your point, how much it's going to cost? One professor at the University of Chicago was looking at what happened when the Mario Cuomo Bridge, the Tappan Zee Bridge, similar comparisons, rebuilding that. He said it's going to be at least $4 billion. And potentially that number can get higher.
Yeah, a line of credit a big, big number, and maybe an indefinite commitment as well. Let's give an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hi, John. The U.S. and its allies are warning Israel of a missile or drone strike by Iran or its proxies. People familiar with intelligence say that the attack against military and government targets in Israel may happen in the coming days, a significant widening of the conflict. The Justice Department has opened an extended antitrust investigation into Nippon Steel's takeover bid for U.S. Steel. The companies had hoped for approval in the second or third quarter, but this will likely delay it. The takeover has become a hot-button issue for this presidential election. President Biden says that he wants U.S. Steel to remain domestically owned, but stopped short of making an explicit push to kill the deal. Donald Trump, for his part, said he would try to block the takeover. Bad weather looks set to disrupt the first day of golf's U.S. Masters in Augusta, Georgia. Officials announced that the first round won't begin before 9 a.m. Eastern. World number one, Scottie Scheffler, is the favorite to win his second green jacket. But bad news for Scottie, no favorite has ever gone on to win the tournament since Tiger Woods did in 2005. Now, as for Woods, he says that he's still capable of winning a sixth green jacket and 16th major if, quote, everything comes together. That's your brief, John.
Danny, thank you. Nothing else matters this weekend. Nothing. Scottie Scheffler, Rory McIlroy, Xander Schauffele teeing off a little bit later. I've got no idea when because of the weather.
Can I ask you, when does it end?
Sunday.
Okay.
Why?
We have a few days left.
Honestly, it's fine. I get to watch him. I get to watch him just talk to himself or talk to the screen. You know, viewer, please write in.
Everyone at home knows this is the most therapeutic golf tournament on the planet. Yeah, it's just quiet. It's beautiful.
Look at that.
It's perfect. There you go. Up next, see, you've got it. You can join Jim Nantz this weekend over at CBS.
Okay.
Slamming the door on June.
The sound that you heard there was the door slamming on the June rate cut. Jay Powell wants to achieve consensus. He can't convince the committee of something the committee doesn't, on average, want to believe.
That conversation up next, live from New York. This is Bloomberg.
I was around so many powerful people in my entire life, from the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Session lows on the S&P 500, negative by 0.5%. Bit softer this morning, a lot softer yesterday. Yields up a single basis point, adding some more weight to that 10-year yield, 4.56 after a double-digit move yesterday. Under surveillance this morning, slamming the door on June.
The sound that you heard there was the door slamming on the June rate cut. That's gone. Jay Powell wants to achieve consensus. He can't convince the committee of something the committee doesn't, on average, want to believe. I still think that they ought to normalize rates over time. I'd be happy enough if they started to cut rates in June. but I think this means that they won't.
Here's the latest this morning. Bond yields soaring on the heels of another hot CPI print, with investors now expecting the Fed's first rate cut to come in September. Ian Lincoln of BMO writing this: if the Fed needs more convincing, Powell run-ups against the optics of cutting rates immediately after the presidential election. We're not willing to take a September first cut completely off the table, but it would require a very sharp deterioration in the labor market to justify seriously pondering a September departure point. Ian, I'm pleased to say, is with us around the table here in New York. Ian, good morning to you.
Good morning. Thanks for having me on.
Let's start at 8:30 yesterday. Let's pretend it's just dropped. If we were a few basis points lower on CPI yesterday and we rounded down to 0.3 instead of rounding up to 0.4, how different would our conversation be this morning?
I think that if we'd actually seen a 0.3 print instead of a 0.4, we would be looking at the data. We might be parsing through some of the details, but we would be thinking that the Fed had it right to assume that January was just a bump on the road to normalization, and we would still be talking about a June rate cut. And so the fact that we're here, no one is expecting June. Everyone thinks that September is going to be hard to pull off. I think really is a fascinating moment for the market.
When the Fed looks at it, how many decimal points is it looking to?
Well, this is where I think it gets very interesting, because the Fed is looking at the translation of CPI and PPI to core PCE. And we actually don't have a solid estimate of what PCE is going to be yet. We'll get that after PPI today.
I do wonder about how much people are looking at the potential for a Federal Reserve to make a policy error based on the political calendar. Because essentially, they have the same conviction that they had earlier about the economic backdrop, but it is highly inconvenient to cut rates at a time where inflation is coming in hotter than expected, 0.4% month over month for several months in a row, and you have a north of 300,000 jobs number.
I'd argue that the negative impact from the election on monetary policy already occurred, and that was in the form of the December pivot. Powell wanted to get ahead of the presidential cycle, socialize the idea of cutting rates, and that's why we rallied into the end of the year, and the Fed has been walking that back throughout much of this year.
Meanwhile, we're talking about how that pivot really fueled these easy financial conditions. How much do you think that that's been fueling a lot of the inflation that we saw yesterday versus just been, sort of a side story to the whole thing?
At the end of the day, I think that it's the resilience of the labor market that's really driving the super core measure of inflation. We had 3 relatively strong average hourly earning prints during the first quarter. And yes, the lofty valuations in the equity market matter. The comparative stability in the housing market matters as well, because it contributes to the wealth effect. But at the end of the day, if we have a 3.8% unemployment rate, it's difficult not to see some degree of inflation on a arguably sustainable basis.
Given that potentially we're going to see more sustainable inflation on this basis, you're talking about, when you look at the jobs market, I still can't get over that more people are working more than one job to keep up with paying their bills. Is that kind of deterioration worrisome for the Fed?
I would certainly think that it is, because we tend to see that dynamic develop at the end of a cycle. It's similar to the way we often see a divergence between the household and the establishment surveys when things are about to turn. And I've personally been very surprised that we haven't seen a more significant correction toward a higher unemployment rate and a weaker jobs profile overall.
Favorite question of mine for you: is this bond market a screaming buy now? Big reset yesterday.
It's getting to the point of being a screaming buy, but we actually did a client survey last week.
I saw that, yeah.
This was ahead of the payrolls number, and the average response said that people would be interested in adding treasuries at roughly 465. If we did that survey now, I expect that number would be a bit higher.
475. This is what drives me nuts about the bond market. People say there's a point where they want to buy, and then the treasury market starts selling off and they run away. Are we all just momentum traders in fixed income?
I think that people have a spread from where we currently stand, where they would get really excited, and that
it's a rolling
tends to go
15
up.
basis points.
It always seems to roll a bit higher until something happens.
Well, if the Fed doesn't cut rates in June, which is what people are expecting, does that make you more bearish or more bullish on the long end?
It ultimately makes me more bullish on the long end, because the reality is, as long as the Fed's holding that 2% inflation target, they might find themselves in a situation where they have to cause a recession or they have to cause a more material slowdown to get inflation back to 2%. So it's a bit counterintuitive because everyone is now in the no landing or the hot landing camp, but this really complicates things for the Fed.
Are you buying?
Not yet.
Let's finish on language, if we can. I just want to squeeze this in. The chairman has said repeatedly it's too early to know whether these are more than just bumps. Are they more than just bumps now for the Fed chair?
I think that this is a meaningful change in the broader inflation narrative. It is more than a bump, but it doesn't mean that the Fed has lost control of inflation.
Okay. Ian, this was great. It's good to see you, as always. Ian Lincoln there of BMO. On this bond market and this rolling, I need an extra 15 basis points, an extra 20 basis points in fixed income. The 10-year, you got an extra 20 yesterday, and now you want another 20. 456 on a 10-year, up 2 basis points this morning. On a 2-year, very close to 5% at about 498. Coming up in the next hour, the third hour of Bloomberg Surveillance, we'll catch up with Jason Thomas of Carlisle, Jane Foley of Rabobank, looking for the euro to drop back to something like 105. We'll speak to Robert Sokin of Citi as well, with the ECB rate decision about 20 minutes away, and then 15 minutes after that, Lisa, on deck, PPI and jobless claims.
Which really will be the final read in terms of understanding the components for core PCE, which is what the Fed looks at. What I think we just heard there from Ian Lincoln, though, this was a clear pivot point. This was a shift in terms of what the Fed can do and how the market's perceiving that. And that is really what I want to hear from the New York Fed president.
That's why the highlight might be John Williams at 8:45 Eastern Time, if we get some comments on that inflation data from yesterday. Equity futures on the S&P 500. If you are just joining us, welcome to the program. We're lower again. Session lows. We're negative 0.5%. From New York, this is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What the Fed has done has put upward pressure on Main Street USA.
I think they're trying to say this is a bump in the road. Maybe bump is the new transitory.
Even if it is a bump, no one's talking yet about a re-acceleration in growth or a re-acceleration in inflation.
I do, though, think this is a fundamentally disinflationary economy, and I just worry about an overactive monetary policy, which we've had for many years.
Inflation's not doing what they wanted on average, and this is a problem for them.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, we're a few weeks into Q2. I just want to go back to the start of Q1. First trading day of the year, we're sitting there. We're going to get 6 to 7 rate cuts in 2024. Buy bonds. You want yields here, you might not get them in the future. Okay, here we are 3 months later. Bond yields are higher by more than 70 basis points at the front end of the yield curve. Yesterday we got an extra 20. Double-digit move right the way through the curve. And here we are pricing in not 7, not 6, not 5, 4, or 3, but maybe 2 or nothing from the Federal Reserve later this year.
People had flirted with transitory earlier this year, and they got their faces ripped off again. And that's essentially what we're looking at, with the Fed basically talking about immaculate, or they never talked about this, the market talking about immaculate disinflation, and now we're looking at just inflation.
No, the Fed's been talking about bumps in the road repeatedly, and now they've had 3 of them so far in 2024. And I've got to give it to Priya Misra. I think with quote of the year so far, maybe bumps in the road to the new transitory, and based on yesterday, Anne-Marie, maybe she's got a point.
Yeah, these look more like baby hills than bumps. I was struck by what Ian Lingon said, because everyone's talking about how uncomfortable the politics might be of this, because you see the market really pushing back the first cut potentially to September. What he had to say, though, is that what the Fed did in December in their pivot and that rally we've seen in the equity market, that was the election hype that Powell set the table for, not this potential cut that might come a month or 2 before the election, and with monetary policy having a lag effect, won't really do much.
Let's sit on that theme, that word, uncomfortable. Let's talk about uncomfortable the next 45 minutes. 8:30, so 30 minutes from now, we'll get jobless claims and PPI. And then at 8:15, so 15 minutes before that, you'll get an ECB rate decision. At 8:45, you'll hear from President Christine Lagarde at the European Central Bank. And we'll talk about what uncomfortable looks like in foreign exchange. It's the euro around 107 with cause for parity again. It's dollar-yen taking out 153. And maybe a BOJ that can't intervene because they're going against the fundamentals of the US economy and the fundamentals of Federal Reserve policy, and a much, much stronger dollar. How uncomfortable will some of these central banks be?
I thought you were going to take that somewhere else. You know what's uncomfortable the next 45 minutes as I sit here with you guys talking about this? No, I'm looking at this sort of question about the FX channel here.
Is that how you feel?
No, not at all. That's why I was so surprised.
If he misses tea time of the Masters.
But if it's uncomfortable.
Tea times are delayed for the weather.
Oh, thank God.
All right, good news.
It's okay.
Carry on.
Great. Look, I'm looking at the FX channel, and I'm thinking to myself, how much is this actually a benefit for some of these central banks? And I go back to the ECB and the idea of a weaker euro actually being positive on the margins, not too much. And so they can diverge, but just not for very long. And I wonder how much Christine Lagarde is going to really point to that.
Japan's top currency diplomat, almost immediately when these yen moves came in, quote, recent yen moves are rapid. Quote, won't rule out any steps to respond to disorderly FX moves. Quote, prepared to take necessary action. Quote, won't comment whether overnight Forex moves are excessive. Quote, excessive FX moves could affect the economy. Continuous, almost this, not even uncomfortableness, like almost obsessiveness on, oh my God, where's that new line in the sand going to be with the yen? I'm not sure if we'll get that kind of uncomfortableness from Christine Lagarde.
So I won't offer my opinion. I'll just go on the program in the last 90 minutes or so, the last 2 hours. MUFG, George Conclave's basically saying this is more uncomfortable for, say, the BOJ than it is the ECB. And what we heard from Julius Baer was essentially that maybe this is what they want, Lisa, to your point. They want a weaker euro because the growth the growth backdrop in Europe compared to the United States is a very, very different story.
And it's really the manufacturing sector that they need to revive. The fact that Germany is the sick dog of Europe right now, and it's also was the strongest dog. So how do you then bring up some of that growth at a time where there's a lot of China competition, especially with inflation, and that really does lead to the currency channel.
That decision from the ECB, 10 minutes away. Equity futures right now on the S&P, negative by 0.5%. We can turn to foreign exchange briefly. The euro, a little softer, 107.29. Yields up again after big moves yesterday, up by 2 basis points. The 10-year, 456.81. Coming up, we'll catch up with Carlisle's Jason Thomas on why the Fed is more likely to hike than cut. Rubberbank's Jane Foley reacting to the ECB decision, and Citi's Robert Socken on why global central bank caution will continue. We begin with our top story. Stocks mixed as sticky inflation dims rate cut hopes. Carlisle's Jason Thomas saying this: it's more likely that rates would move up than down. Fed policy on the whole is too accommodative with their guidance towards rate cuts. There isn't a case for cuts. Jason joins us now for more. Jason, wonderful to get your thoughts on this program. Thanks for being with us, sir. How did yesterday change your base case for 2024?
Well, I think the discourse needs to change. Since the November 1st FOMC meeting, we've observed a massive easing of financial conditions. Stocks up by about 25% on average, with fairly broad participation in that rally. 10-year yields fell peak to trough by over 100 basis points. And also credit markets. If you look at single B spreads and high yield bonds, just over 300 basis points, within 50 to 60 basis points of the all-time tights of that time series dating back since 1996. So this response in financial conditions since November is actually looks reminiscent of what we saw when the Fed launched rounds of QE in the past decade. And I think that, it's not the base rate, which has remained unchanged, that's so central to inflation determination, but of course these broader financial conditions. So I think today the Fed has to look at these data, look at a services sector that looks to be bursting at the seams, just as the demand in experiences, entertainment services continues to grow, and really just change this discourse to think right now that, looking forward, we don't see any rate cuts. And then I think you can allow for a tightening of financial conditions that may eventually, by year end, put you in a situation where you're feeling more comfortable on the inflation front.
Jason, what I hear from you is that you think we need tighter financial conditions. The Fed chair says we are sufficiently restrictive. Do you think we are insufficiently restrictive based on what I'm just hearing?
Well, of course. I think, again, as of November, the Fed said that they didn't need to hike further because financial conditions had tightened sufficiently. The market effectively did the Fed's work for it. And I think that was right at the time. But again, when you look at whatever metric one wants to look at, or collection of metrics to try to ascertain where financial conditions stand, it's hard to say that through the first 3 months of this year, you had tight policy. It's not the base rate that matters. The Fed funds rate is an overnight interest rate that is applied to about $85 billion of transactions. It's meaningless. It's only the extent to which those instruments, the balance sheet, the base rate, guidance, actually influence financial conditions. And again, on that score, you would have to conclude that policy has been too easy to hit a 2% inflation target. And I think that gets into questions about, is the Fed, effectively, implicitly moving to a higher target? If the discourse doesn't change, I think that is going to be the takeaway among many market participants.
Which certainly is what we're seeing and hearing in all the notes overnight as people look at maybe a 2 to 3% range for the potential for inflation. As an investor, though, when you take a look at how easy financial conditions have been, do you push against that? Do you sell credit? Do you avoid those areas? Or do you lean in and say, this is a Fed that wants to remain accommodative and that wants to run this economy hot?
Well, I think running the economy hot, may turn out just fine. The economy is performing very well. Earnings growth looks very solid. I think the risk in the situation, however, is the federal budget deficit. And what I mean by that is some market participants may conclude that the Fed is not moving to a higher inflation target willingly. It's actually succumbing to fiscal dominance. And it's now setting policy based on the funding needs of the Treasury, setting policy so as to limit the Treasury's net interest expense, which of course has been growing explosively. And if that happens, if that is a broadly shared sentiment, watch out for long-term bond yields. Because if a central bank is setting policy, again, on the basis of what the Treasury, the fiscal authority needs to fund itself, it loses control of the price level. Again, these are tail risks. This is not anyone's central forecast. But as these perceptions gain hold, you could be looking at much, much higher long-term bond yields and a much steeper curve. So for me, in this environment, I really like floating rate loans, CLOs, where you're actually profiting from riding out these base rates. As mentioned earlier, that this idea of needing to buy bonds because they go to 4.5% or 6% in some investment grades, let's lock in these yields now, that's proven to be a bad trade. And I think there's a lot of embedded duration risk that people need to be cognizant of.
Jason, you have a lot of proprietary research overseeing all the portfolio companies at Carlyle. What's your understanding of what benchmark rate becomes restrictive for these companies? At what point these higher yields really do pose an existential risk to their business models?
Well, I don't see existential risk, but what I would say is that over the past several months, and certainly much of 2023, the expectations of rate cuts and the expectation that the terminal rate is still much, much lower than current levels of the Fed funds rate allowed a lot of businesses to swap 2-year, 3-year to 5-year and lower their borrowing costs. So again, it's not the overnight rate that matters. If you had a flat curve at 5.3%, or if you had an upward sloping curve from 5.3%, that would be more than sufficient, I think, in my view, to bring inflation down to target. So again, it's not the base rate that matters here. Secondly, I would just say that one of the effects of higher interest rates that's been interesting is, of course, increasing finance costs. So it's more difficult for consumers, of course, to buy homes, but also durable goods, renovations. So what's happened is the spending has actually moved to experiences, to services. And again, this is precisely where the inflation is. If you look at household balance sheets, what you find is about 85% of the debt is fixed rate. Almost 3/4 of that is of course, long-term mortgages. The effective interest rate being paid on that $13 trillion stock of mortgages is still only 3.8%. So you have the rate hikes have done nothing to dent household cash flow. So households on average are still able to spend with the growth in compensation. Again, because of higher finance costs, it's meant that spending has been redirected into experiences.
Jason, this was deeply thoughtful stuff. Appreciate your time. And hopefully we can do this again soon. Carlyle's Jason Thomas there on this market and the Federal Reserve not being sufficiently restrictive, but insufficiently restrictive. Equities right now on the S&P, negative 0.5%. Up next on the program, the ECB rate decision.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
The decision from the European Central Bank just seconds away. The scores going into it shaping up as follows. I'll begin with equities and we'll work our way through the bond board and finish on the euro. Equity futures on the S&P 500 negative by 0.5%. We're down another 1/3% on the Nasdaq 100. In the bond market, the scores following yesterday's major moves. Stateside, Treasury yields higher by another 2 basis points, 4.5620. And in foreign exchange for the euro, hit hard by the data from yesterday and the bounce in yields. The euro negative to 107.33. Interest rates just about unchanged then, 4.50 on the refinancing rate against an estimate of 4.50. The marginal lending facility at 4.75 as expected. The deposit facility, that interest rate coming in at 4% against a median estimate of 4% and a previous number of 4% as well. Great expectations that maybe the ECB is going to make a move sometime soon. They've signalled quite firmly that that could come in June. The question we've had over the last 24 hours is whether the CPI data stateside would change their story with them, given the strength of the US dollar and the weakness we've seen in the single currency. So rates unchanged at the ECB and a bunch of headlines, Bramo, to work through.
Yeah, we're looking at the idea that they do plan to focus on the idea of reducing inflation in a timely manner, which is interesting given that there seemed to be more flexibility in the time that we heard from Fed Chair Powell, also talking about how they do see substantial progress when it comes to the disinflation in the region, and they are going to continue applying flexibility on the PEP reinvestment. So to me, the idea of sufficiently restrictive being a key term that they keep using, and the fact that they want to have a timely reduction in inflation kind of pushes against this idea of being a lot more dovish in the face of what some people are talking about might be an opening for them.
The things the ECB can say, I think, today that the Federal Reserve can't. This quote right here from the ECB in their statement: financing conditions remain restrictive and the past interest rate increases continue to weigh on demand, which is helping to push down inflation. But domestic price pressures are strong and are keeping services price inflation high. I want to cross over to Lizzie Burden and catch up with Lizzie over in Frankfurt. Lizzie, a lot of attention on this ECB news conference coming up later on this morning in about 30 minutes' time, given there is still expectations out there that they're going to cut interest rates in June when maybe the Federal Reserve cannot. What do you see in communication this morning?
Yeah, John, just looking at this decision, it is exactly what we expected in the sense that they stood pat here. Why? Well, they've told us why. They've said inflation's continued to fall. Most of the measures of underlying inflation are easing. The rate level's making substantial contributions to reaching that 2% level. But you've already seen services inflation sticky, yes, but growth prospects in the euro area improving. So it gives them room to wait a little longer. They have said that they want to wait for that wage data in June before making the decision. So as you say, really in this press conference, we're listening to Christine Lagarde on her tone as to the path for rates beyond June, because economists were expecting quarter-point cuts each quarter off the back of this. You've seen traders changing their pricing, holding ECB rate bets steady, in fact, pricing 19 basis points of cuts by June. So that's the reaction in markets.
Lizzie, this line here from the European Central Bank, not pre-committing to a particular rate path. Lizzie, how different is the communication we're getting from the ECB, or how similar is it to the coverage that you do for us over at the Bank of England? How similar are those two stories at the moment?
Nobody wants to be the unreliable boyfriend, John. Look, from the ECB, there's nothing explicit here, and that's kind of what we expected, that they're not going to want to make commitments before seeing that crucial wage data. And it's the same picture in the UK from the Bank of England, because there's so much uncertainty in the economic outlook at the moment. But the big question for the ECB is, when the divergence from the Fed, as you say, looks inevitable, what about Euro weakness? weakness. I know you spoke to Mohamed El-Erian warning about euro-dollar parity. Will Christine Lagarde in this press conference mention that volatility in the exchange rate and the potential for it to feed back into Eurozone inflation? That's what I want to listen for.
Lizzie, it's interesting you mentioned foreign exchange because we are seeing the euro soften a bit versus the dollar after this release, which was sort of surprising to me given that at least the risk of them having a cut at this particular meeting has been taken off the table. Is there anything that can be viewed as particularly hawkish in this release?
Well, we didn't expect to see a cut today. In fact, only one of 62 economists that Bloomberg surveyed expected to see a cut today. So that in itself isn't dovish. Just looking at it, given that traders aren't changing their pricing off the back of it, it doesn't seem especially hawkish yet. But this is why Christine Lagarde is going to have to mind her tone, especially carefully in this press conference today, with an eye on euro weakness.
Lizzie, great to see you over in Frankfurt, Germany. Lizzie Burden there of Bloomberg breaking down that ECB rate decision. A key quote, key paragraph, I think, in this statement this morning that a lot of people will be going over. If the Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission were to further increase its confidence that inflation is converging to the target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. That quote, if you're sick of hearing that, you're going to be very, very ill at the end of the news conference, because I think you're going to hear that on repeat from President Lagarde. You'll hear from President Lagarde in about 25 minutes' time. Jane Foley of Rabobank joins us now for more. Jane, those three conditions at the ECB, do you think we're pretty close to meeting them to cut rates in June?
I think we are pretty close to meeting them, but certainly had you asked me yesterday morning before the CPI data in the US, I would probably said, yes, we're even more close to reaching them. There has been a little bit of a thorn in the side. What impact will the exchange rate have on the timing, not just necessarily of the June move or if there is a June move, but actually further out during the end of this year. But, there is one caveat, which I really do think we need to throw in this context. I think that the weaker euro is probably only of significant relevance to ECB policy decisions if we are simultaneously getting a hike in the oil price. Now, we've seen Brent today trading at the $90 a barrel level. Clearly, last week, this week, the market concerned about an escalation in the crisis in the Middle East. If oil trades higher, then the weakness of the currency becomes a bigger issue. Other than that, if oil prices were lower, I'd be feeling a lot more comfortable about the ECB cutting interest rates despite a softer euro. And that is because the very fact that the central banks are turning towards interest rate cuts means that they're in the transition. They're pivoting away from inflation concerns towards growth concerns. And that means that the softer euro is going to be less of a problem, but that oil price could certainly be an issue for them.
Jen, you nailed it. I want to stick on that theme. I think it's important. Let's go through those three conditions again. The Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. Just on the third one, the strength of monetary policy transmission, does it weaken if the euro is too weak and crude start running away? Does that mean one of those conditions just can't be met?
Well, quite possibly. If the euro is weak and oil prices are strong, then you're going to get more imported inflation, and therefore you have less confidence if you're at the ECB that inflation can be brought down to target sustainably. And I think there's been a lot of emphasis on the word sustainably from various different central banks in the last couple of years. So that is a significant risk to them. That said, if we look at the Eurozone economy, particularly maybe the German economy, and reference it back to the US, well, we see a lot of weakness. We see stagnation that's been going on for some time. And I would say that there are an awful lot of German companies who are still reeling really from the energy price crisis in Europe, that they would actually really benefit from a softer euro because it would help their exports. But that can only happen if the ECB is confident that inflation can remain at these lower levels.
Jane, can you put some price levels on it in terms of what price of crude it has to look like for the ECB to get confidence to cut rates, and frankly, with the idea of a weaker euro?
I think with all of these levels, it's the price plus the volatility that we're seeing. And I think that really does depend on the news. It's quite likely, again, ahead of the coming weekend, that the market will probably take oil price a little bit higher, just in case we get an escalation in the news from Iran. Maybe it'll come back down again on Monday, like it did in the week just gone. So it's very difficult to predict what's going to happen. But I would certainly say that if we saw oil prices, pushing up to 100, and if that happened quickly, then we're perhaps looking at a different sort of scenario. Now, that may not mean that there's a change in June expectations, but it may mean that there's a change in expectations about how many interest rate cuts we could potentially get from the ECB or for other G10 central banks, for that matter, during the course of the rest of the year. So I think oil prices really do have to be brought into the equation over the next few weeks, next few months maybe.
Jane, so you're looking around 105 for the euro dollar. I'm just wondering how much more there is to the dollar strength that we've seen, given that does continue to be the haven trade in light of the recent inflation data.
Well, you can talk about it as a haven trade, but I think that is certainly part of it. But there is just the inflationary impact. I mean, if we look ahead, and we've been talking about this for a while, if we look ahead to the U.S. election, if we were to get maybe a Trump presidency, he's talked about some very significant tariffs. Now, that means prices of some U.S. goods could go up quite substantially. That would mean that actually the Fed's easing cycle could be really quite short. Maybe 2 interest rate cuts this year, maybe 2 next year, and then that's the end, or at least a pause into the middle of the year, because CPI could get another push up because of that. So, there's a lot of variables here, but generally speaking, most of them are speaking to a stronger for longer US dollar.
Hey, Jane, wonderful to get your reaction to that ECB decision. Jane Foley there of Rabobank, unchanged at the ECB, still expecting a change from this European Central Bank, perhaps in the month of June. You'll hear from the President, Christine Lagarde, in 20 minutes' time. The next stop for this market, some data for you. PPI data and jobless claims just around the corner. Citi's Robert Socket is going to be with us to react to all of that. Will this really slam the door shut on June? Because I know for those of you still clinging to a June rate cut, PPI data is kind of the last piece in the puzzle. That data is up next. Equity futures session low is negative 0.5% on the S&P 500. Yields are higher again. We're up 3 basis points on a 10-year, 4.57. From New York, the data up next.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
$56.81 with your economic data. Here's Mike McKee. Morning, Mike.
Good morning. Well, we're all watching PPI to see what it means for PCE after CPI. and once we put all those acronyms aside, PPI for final demand up 0.2% comes in lower than anticipated and significantly lower than last month's 0.6%. The core also at 0.2. That's what was forecast. And the supercore ex food, energy, and trade at 0.2, also what was forecast. PPI on a year-over-year basis is up, though, final demand 2.1%. It was 1.6%. There is some base effects coming into play there. The core, 2.4%. That's up from 2%. The supercore with trade included 2.8%. No change there. So on a month-over-month basis, good news basically from PPI. On a year-over-year basis, we see some increases. Jobless claims. After last week's jump up to a revised 222,000, we fall back to 211,000. So we are still in that range, and we are still seeing a relatively tight labor market. Continuing claims, 1,817,000. That is up from 1,791,000. But normally you'd say that might suggest people are having a harder time getting work, but this has been a very volatile number, goes up and down. So I don't think we can draw any conclusions from continuing claims.
Well, I can tell you, look at this recovery in the equity market. Let's start there. Equity futures, and start with the Russell if you want. Basically unchanged now on a session, on a small caps. We're positive on the NASDAQ by 0.1% and erasing almost all the losses of the morning on the S&P 500. A rare piece of good news. And relative to yesterday, fantastic news. Jobless claims lower as well. Yields are lower by 2 basis points at the front end, 4.95. At the longer end on a 10-year, still higher by, let's call it half a basis point. We were higher by 2. We're back to about 4.55. So, Lisa, not exactly undoing the moves of yesterday, but a rare piece of good news relative to the news 8:30 yesterday morning.
Again, the fact that the market moves at all on 0.1% one way or another, it just highlights how little people really understand this. The Russell 2000 is what I want to watch more closely, because if you get input prices to some of these smaller businesses that aren't rising quite as quickly as consumer prices, well, that speaks to the margin question, right? Can they pass along more of this than they're absorbing on the bottom line? But truly, what we're looking at right now is people toggling between, okay, is this it, sticky inflation long term, or is this just basically a bump that's a little more problematic?
So, Mike, what is it? You can take CPI yesterday, a few elements from that, take PPI this morning, a few elements from that, push it through PCE. What do you get? Good news or bad?
Well, we're going to, probably good news. Relative good news these days. PCE has always runs below CPI, and this is probably going to confirm that we will see a lower PCE number, which will factor into the Fed's thinking. I don't know that it changes it, but it doesn't factor in so much to the market's thinking, and it's your fault. According to the BLS, A major factor in the March increase in prices for final demand services, they were up 0.3. That was what really pushed things up, was securities brokerage, dealing, investment advice, and related services, which were up 3.1%. So cut prices over on Wall Street, and we have no problem anymore.
I'm sure this is going down really well right now, Ramo, on Wall Street. Is it? I don't think so.
Honestly, I think Wall Street's saying, cry us a river. Right now, we're looking at the idea of a little bit more of a rally into the front end. I do wonder how much the Fed's hands are really tied, though. The PPI doesn't matter as much as consumer prices, and the fact that the jobs market is just obviously robust, given the fact initial jobless claims confirm week after week after week. We do not have a layoff problem that's really evident in the numbers. How can they justify cutting rates in June? How could they justify cutting rates anytime soon with these kind of numbers, even if PPI came in a little bit light?
Well, as of today, which is April 11th, they can't justify it because the numbers don't show us, but we will get 2 more CPIs before the June meeting, and we will get another PCE before the June meeting, so we get 2 PCEs. So they will have some additional numbers to work with, and we'll see what happens with inflation in these various measures. But you go back to the old saying that 1 data point is a fluke, 2 is a coincidence, 3 is kind of a trend. And so we seem to have a trend in inflation here, and we'll have to see if that gets broken. We'll see what in final demand goods and PPI translates into CPI, which is not a direct translation for most things, but it sort of follows the same path.
Well, given PPI was better, potentially we'll get a little bit better PCE, but CPI is what everyday Americans think about when they think about inflation. How concerning is that inflation expectations for the future are going to be higher off of this now, not so much bumps, but as you say, trend?
Well, it would be something that you would be concerned about, and it's certainly possible that it can happen, but we have seen very high inflation over the past couple of years. That has now come down, but we didn't see consumer inflation expectations rise significantly, nor did we see business expectations for inflation rise significantly. So the Fed is relatively sanguine about that situation. Now, it'll be interesting to see, because this is political year, there'll be a lot of TV commercials talking about how inflation is terrible, and we'll see if that gets into people's heads.
I imagine very different TV commercials depending on the party. Mike McKee, thank you, sir. If you are just joining us, welcome. About 5 minutes ago, we got some economic data for you. PPI coming in at 0.2%. The estimate for final demand month over month was 0.3. So a little bit of a downside surprise there relative to the upside surprise of yesterday. Strip out food and energy, you get 0.2, bang in line with the estimate of 0.2. Lisa talking about jobless claims. We should talk about jobless claims. That came in at 211. The estimate was 215, so the right kind of downside surprise. Equities recover. The Russell was down hard this morning. Again, after big losses yesterday, it's positive by 0.25% on the NASDAQ, up 0.2%. On the S&P 500, just about unchanged. If you turn to the bond market, yields lower by 3 basis points now at the front end, back down to about 4.94 after getting closer and closer to 5% over the last 24 hours. On a 10-year yield, about 4.54 on a 10-year right now, 4.53.55. Joining us is Citi's Robert Sockin. Citi, I know you've got over at Citigroup, Robert, that call for June for a rate cut, and I just wonder, is it just about holding on by its fingernails after that PPI print?
Thanks so much for having me. Yeah, we're still holding on to that June call. I think it's a very close call at this point. As Michael McKee had said, you know, once you have 3 months of data, you start to think that might be a trend. And we've seen fairly hot inflation data throughout the first quarter of this year. We do think we have to see how it shakes out with PPI. If core PCE is coming in around 0.3 is probably the limit, or maybe somewhere below that would be okay. If you're running that type of rate, we think Chair Powell would feel comfortable at least starting to ease in June. But again, if it comes in something like 0.3, that's probably the borderline of where we'd feel comfortable. So I think the inflation numbers are going against the call, and certainly the probability of it have gone down. But that PPI, we'll see how it shakes out with the core PCE estimates. But overall, that's pretty good news. So we think, and also this is a Fed that seems to really want to get the easing cycle started at some point this year. So on balance, we're holding on to it. But again, you know, it's going to depend on those next few inflation prints and how the labor market evolves.
Rob, for a while, you and the team at Citi have said this Federal Reserve has shifted emphasis. It's putting a greater emphasis on the potential for labor market weakness. And in line with that, I think the perceived reaction function from the market of the Federal Reserve has shifted as well. Maybe up until yesterday, there was this belief that the Federal Reserve could respond to adverse shocks, maybe weakness, pronounced weakness in the labor market because of these disinflationary trends. Rob, what I'm trying to understand is whether that story has been damaged by the print of yesterday or not. Do you think it has?
Yeah, this is the tough question, because that's certainly been part of the impetus for our call. Is we do think there is enough signs of softness in the labor market, not so much in the overall aggregate numbers. So hiring is still strong, jobless claims are still low, but you are seeing things like hiring intentions fall significantly from small businesses. You see things like the hiring rate drop notably in recent quarters. So we think there was enough softness that the Fed was getting worried that the labor market was weakening too much, and that you could be heading into a recession. I still think that's a big backbone of the call, but now that has to be weighed, as you said, against these stronger inflation prints. I do think if we do see more signs of weakening, the Fed would lean more on that element and still like to start this cutting cycle. But exactly as you said, it complicates the math, because before we were getting inflation that was good enough and some signs of softening, but the last few months have been much stronger inflation than we were expecting.
Rob, you kept saying that this is a Fed that wants to cut, and a lot of people have been asking why. And there are a lot of conspiracy theories, and then there are questions around just some of where the weakness is coming from. We heard from Jason Thomas of Carlyle earlier this morning that one of the reasons why is the deficit. And as it balloons, borrowing costs are getting more punitive for the United States. How much do you think that's factoring into the decision to try to cut rates at a time when a lot of that deficit's financed through T-bills?
Yeah, great. It's a great question. Certainly, on the one hand, those deficit numbers are looking very large, and interest costs have been growing significantly as a share of the overall deficit. I don't think, though, that that's the primary concern of the Fed. I think in the Fed's mind that they feel like they've done enough. They feel like they're restrictive, and they do feel like they're seeing enough progress on inflation and enough signs of loosening in the labor market and softening in the economy that they're willing to start easing, especially if they are starting to get concerned about those downside risk activity. So I don't think that concern is primary in their mind, but more broadly, I do think that is an issue. That deficits are getting big, and that's something policymakers have to pay attention to as interest costs are higher. But primarily, the Fed is focused on getting inflation back down to target and maintaining activity in the economy.
Rob, have you changed your long-term inflation forecast for the United States in the heels of some of these prints and your belief that the Fed will still cut?
No, we haven't changed the longer-term outlook in terms of inflation will gradually go back down to target over the next few years, have somewhat of a sticky path down because we think that services inflation is going to take longer than many people think to come back down to more stable levels. And as mentioned, still have the Fed cutting in June, but I think the risks around that forecast have changed. The risks are looking more tilted towards inflation stays even higher for longer than we've had, and the risks are looking that the Fed starts that easing cycle a bit later. So we're holding on to those similar views, but I think the risks have definitely tilted in a different direction.
Robert, this was great. It's fantastic to hear from you. Robert Stocking there of Citi, just about holding on to this June rate cut call. Question for us, I guess, this morning is how much the PPI printed this morning, downside surprise on a margin, offsets the damage of the upside surprise yesterday on CPI. I won't give you the answer. I'll allow the market to do that for you. Yesterday on the 2-year, we were higher by 23 basis points. This morning, we're down by about 5. So the answer, I guess, is a little bit. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The ECB has kept rates on hold for a 5th straight meeting. They signaled they're not far off from beginning to cut as well. Officials said that easing can start if their updated assessment of their inflation outlook increases confidence that prices are heading back to target in a sustained manner. Of course, they have the issue of widening rate differentials if the Fed cuts are pushed out. ECB President Christine Lagarde is set to hold a news conference in just a few minutes. That will be at 8:45 a.m. Eastern. The Justice Department has opened an extended antitrust investigation into Nippon Steel's takeover bid for U.S. Steel. The move likely delays the $14 billion deal. Both companies had hoped that it would be approved in the second or third quarter of this year. The potential takeover has become a hot-button issue for the presidential election. President Biden has said he wants U.S. Steel to remain domestically owned, but he stopped short of making an explicit push to kill the deal. Donald Trump has said he would try to block the takeover. A sweeping Russian missile attack on Ukraine has destroyed the largest power plant near the capital of Kyiv. Russian forces have ramped up strikes on energy infrastructure as Ukraine faces shortages of ammunition and manpower. Ukrainian President Volodymyr Zelensky called the air defense the biggest challenge today while making a visit to Lithuania. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, a news conference at the ECB with President Christine Lagarde.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We'll do a couple of things over the next few minutes. In just a moment, we'll head over to Frankfurt, Germany, and we'll hear from President Christine Lagarde at the ECB, following a rate call a little bit earlier, unchanged, but still expecting a June rate cut. And just crossing the Bloomberg, comments from the New York Fed President, John Williams. Bramo in focus after the big upside surprise yesterday on CPI.
This is the key. We're not there yet. We've made a lot of progress toward our goal of inflation, but we have not seen the total alignment of our dual mandate quite yet. He did anticipate bumps along the way, so here comes the bumps word again, which somehow has entered the transitory lexicon of some, but he is talking about how there is normalization in the labor market, expecting a peak unemployment rate of about 4% for the remainder of this year.
Aren't 3 bumps a bit of a trend? Shouldn't there be some pushback now to this conversation?
Well, the market's pushing back big time. And that's really going to be the key question. How does he respond to that? If he does indicate that the market is sniffing out what they also are, a pushback, it's going to be really curious to see. So far, it's non-committal from all of the Fed members who've been speaking. They aren't going to say, this is going to change our view, but they're all raising caution, humility, we're not there yet, waiting. Is that enough to have a couple of months' data that they're going to be convinced by June?
More Fed speak throughout today. Let's turn to the price action. Equity futures on the S&P 500 just about unchanged to negative by not even 0.1%, recovering after PPI comes in a little bit softer than expected. If we switch up the board and get to the bond market, the 2-year, 10-year, 30-year yields a bit lower now at the front end by 4 basis points at 493.55. And turn to foreign exchange, just getting introductory remarks in Frankfurt, Germany, before ECB press conference begins with President Christine Lagarde, the euro at 107.31. With the news conference in Frankfurt, Germany, here's the ECB President Christine Lagarde.
Welcome you to our press conference.
The Governing Council decided today to keep the 3 key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation has continued to fall, led by lower food and goods price inflation. Most measures of underlying inflation are easing. Wage growth is gradually moderating, and firms are absorbing part of the rise in labor costs in their profits. Financing conditions remained restrictive, and our past interest rate increases continue to weigh on demand, which is helping to push down inflation. But domestic price pressures are strong and are keeping services price inflation high. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We consider that the key ECB interest rates are at levels that are making a substantial contribution to the ongoing disinflation process. Our future decisions will ensure that our policy rates will stay sufficiently restrictive for as long as necessary. If our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. In any event, we will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction, and we are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The economy remained weak in the first quarter. While spending on services is resilient, manufacturing firms are facing weak demand and production is still subdued, especially in energy-intensive sectors. Surveys point to a gradual recovery over the course of this year, led by services. This recovery is expected to be supported by rising real incomes, resulting from lower inflation, increased wages, and improved terms of trade. In addition, the growth of euro area exports should pick up over the coming quarters as the global economy recovers and spending shifts further towards tradable. Finally, monetary policy should exert less of a drag on demand over time. The unemployment rate is at its lowest level since the start of the euro. At the same time, the tightness in the labor market continues to gradually decline, while with employers posting fewer job vacancies. Governments should continue to roll back energy-related support measures so that disinflation can proceed sustainably. Implementing the EU's revised economic governance framework fully and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. National, fiscal, and structural policies should be aimed at making the economy more productive and competitive, which would help to reduce price pressures in the medium term. At the European level, an effective and speedy implementation of Next Generation EU program and a strengthening of the single market would help foster innovation and increase investment in the green and digital transition. More determined and concrete efforts to complete the banking union and the capital market union. Inflation has continued to decline, from an annual rate of 2.6% in February to 2.4% in March, according to Eurostat's flash estimate. Food price inflation dropped to 2.7% in March from 3.9% in February, while energy price inflation stood at minus 1.8% in March, after minus 3.7% in the previous month. Goods price inflation fell again in March to 1.1% from 1.6% in February. However, services price inflation remained high in March at 4%. Most measures of underlying inflation fell further in February, confirming the picture of gradually diminishing price pressures. While domestic inflation remains high, wages and unit profits grew less strongly than anticipated in the last quarter of 2023. But unit labor costs remained high, in part reflecting productivity growth. More recent indicators point to further moderation in wage growth. Inflation is expected to fluctuate around current levels in the coming months and to then decline to our target next year, owing to weaker growth in labor costs, the unfolding effects of our restrictive monetary policy, and the fading impact of the energy crisis and the pandemic. Measures of longer-term inflation expectations remain broadly stable, with most standing around 2%. The risks to economic growth remain tilted to the downside. Growth could be lower if the effects of monetary policy turn out stronger than expected. A weaker world economy or a further slowdown in global trade would also weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could be higher if inflation comes down more quickly than expected and rising real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Upside risks to inflation include the heightened geopolitical tensions, especially in the Middle East, which could push energy prices and freight costs higher in the near term and disrupt global trade. Inflation could also turn out higher than anticipated if wages increase by more than expected or profit margins prove more resilient. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens more than expected. Market interest rates have been broadly stable since our March meeting, and wider financing conditions remain restrictive. The average interest rate on business loans edged down to 5.1% in January. The edge down in February to 5.1%, coming from 5.2% in January. Mortgage rates were 3.8% in February, down from 3.9% in January. Still elevated borrowing rates and associated cutbacks in investment plans led firms to reduce their demand for loans in the first quarter of 2024, as reported in our latest bank lending survey. Credit standards for loans remained tight, with a further slight tightening for lending to firms and a moderate easing for mortgages. Against this background, credit dynamics remain weak. Bank lending to firms grew marginally faster in February at an annual rate of 0.4%, up from 0.2% in January. Growth in loans to households remained unchanged in February at 0.3% on an annual basis. Broad money, as measured by M3, grew at a subdued rate of 0.4% in February. So, in conclusion, the Governing Council today decided to keep the 3 key ECB interest rates unchanged. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We consider that the key ECB interest rates are at levels that are making a substantial contribution to the ongoing disinflation process. Our future decisions will ensure that our policy rates will stay sufficiently restrictive for as long as necessary. If our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. In any event, we will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level of and duration of restriction, and we are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Jana Rando of Bloomberg. Jana, please.
Good afternoon. Thank you very much for taking my question. Here.
There you go.
I heard you loud and clear on the confidence needing to increase for restriction to be removed. And I also heard you saying that you're not pre-committed to a specific policy path.
I was trying to read as clearly as possible.
There you go. Message received. But I do want to ask you whether you believe that such levels of confidence that you talk about can be reached by the time you next gather to set policy in June. And as a side note to that, I would be interested in knowing whether there were some colleagues around the table today that thought time might have already come today. And the second question, and I know that you are going to say we set policy for the Eurozone, and I appreciate that, but I'm wondering whether surprisingly hot inflation data out of the US and the reactions it triggered over the past hours, or 24 hours or so, have changed in any way the way you think about the ECB's policy path going forward. Thank you.
Well, thank you so much. And, you are the first question, but you seem to be covering quite a bit of ground that maybe others wanted to cover as well. So I'll try to respond briefly to give others a chance as well to ask similar questions. So you heard me loud and clear indicate in that new sentence, which is prominent in our monetary policy statement, that, and I'll read again, if our updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. It's an important sentence because it really describes the mechanics, and it better clarifies our reaction function and the process through which we are engaging. And I have said previously that in April we get some information and some data, and we looked at all that. But in June, we know that we will get a lot more data and a lot more information, and we will also have a new projection, which will incorporate and be informed by all that that will be published before projection is completed. So we are data dependent. We will be looking at all this information, all this data, and the projection results that will be produced by the entire Euro system, not just the ECB. And then we will determine whether all of that confirms our hope that inflation returns to target in a sustained manner, and if as a result our confidence is sufficiently reinforced. I think that's really the mechanics that we will adopt, that we have resolved to adopt, and that we will follow in the coming meetings. Now, you asked me whether everybody was exactly on the same page. Truth be told, a few members felt sufficiently confident on the basis of the limited data that we received in April. It was just a few members. And they agreed to rally to the consensus of a very, very large majority of the governors who were comfortable with the need to reinforce confidence when receiving a lot more data in June. Your third question, because you asked the third question, you asked whether the US CPI number received yesterday had any bearing and subsequent market development. I have said in the past that we are data dependent. We are not Fed dependent. That was not the Fed, that was CPI numbers. And obviously, anything that happens matters to us and will in due course be embedded in the projection that will be prepared and released in June. And you know, the United States is a very large market, a very sizable economy, a major financial center as well. So all that finds its way into our projections. Thank you.
Thank you, Madame Lagarde. The next question for CNBC, Annette Weisbach. Annette, please.
President Lagarde, thank you very much. I have a question referring as well to the Fed, because clearly if the Fed doesn't cut, we'll probably see that in our exchange rate, the euro exchange rate to the dollar. So how much is that of a concern to you, that the euro exchange rate could actually fall to parity or below, and what does it mean for inflation? And then did you discuss shrinking the balance sheet a little bit faster than we are than currently planned, because clearly that's also a policy tool. Thank you.
You know, first of all, I would not speculate what other central banks are or are not going to do. And I think that, as I just responded to the previous questions, consequences in terms of impact on price stability, impact on inflation, whether it is imported inflation or otherwise, all that, of course, needs to be taken into account and is monitored very carefully and finds its way into our projection. So all of that will be included, embedded, monitored, and taken into account in our projection. But you know, we don't target exchange rate, we don't comment on exchange rate, and I'm not going to go any further than that. I would simply mention that you know, there are multiple channels through which influence can be exercised. It's not just through exchange rates. I think there are other channels. The size of our balance sheet has quite significantly reduced already, and I'm sure you have followed that very carefully. The entire very large TLTRO reimbursement that was coming due in March has been entirely reimbursed, of course, and additional over 30 billion euros has also been added to the reimbursement. In addition to that, given the APP gradual runoff, we also reduce our balance sheet by an average of about $30 billion per month. And that process is ongoing and will continue to happen as anticipated, as predicted, and as determined by the maturity of those bonds that come to runoff. And then we will move to the reduction of the PEP reinvestment until from the 1st of July until the end of December, and then that's the plan. But there is no further discussion on that.
Thank you, Madame Lagarde. And the next question for Francesco Canepa of Reuters. Francesco, please.
So
inflation was on the way up in 2021, 2022, a global phenomenon, or so it turned out, even though initially you guys were not expecting it to spread to the Eurozone so much.
You guys, you refer to the Governing Council?
Yeah, the ECB, the projections did not expect inflation to be high in the Eurozone as it was in the US. So what makes you think that this time around it will be different and the Eurozone can diverge from the US and where inflation rates are kind of refusing to fall further? Yeah, that's it. Well, as a second question, if I may then, is your confidence about the condition being met in June lower than it was, for example, a month ago as you were speaking at the ECB Watchers, or is it intact?
Well, thank you for picking up on the Watchers speech. I think that's the one that you're referring to, in which I tried to describe as accurately as possible the sequences that we went through. The hiking cycle, the holding cycle, and the prospect of the dialing down cycle. And I think that most, if not all, that I have said in that speech still holds to this day. And I describe, I think, in very specific terms what the confidence level should be and on what basis we're going to nurture that confidence and reinforce it over the course of time in that process. So, you know, I'm not going to comment on whether I'm more or less confident. I think that what we are saying in the MPS today is that if, and I'm not going to bore you with repeating, but if the updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission were to further increase our confidence that inflation is sustainably at 2% as we anticipate, then it would be appropriate. So that stands very much, and it's completely the continuation of the Watchers speech that I gave about 10 days ago. So you asked me about the distinction that we should or that we should not draw between euro area inflation and US inflation, and why would we not be entirely US inflation dependent in a way, or US CPI dependent? Should we take our cue from that? You know, we are operating in the euro area with the euro area economy for the benefit of the Europeans. Our objective is price stability, and we have to determine our monetary policy decisions on the basis of the data that are produced by the euro area, on the basis of the global environment, and that includes obviously the United States, but it also includes China, which matters. It also includes Japan, which matters, and a lot of emerging market economies that also have a bearing. But we focus predominantly on the territory for which we have responsibility for monetary policy. As you know, and as I'm sure all of you in the room know, the nature of inflation in the euro area was different from the nature of inflation in the United States, notably. The drivers of it were different, the fiscal response was different, the consumption by US consumers is of a different nature, investments were different. So I don't think that we can, you know, draw conclusions based on an assumption that the two inflations are the same. They are not the same. The two economies are not the same. The political regimes are not the same. The fiscal policies are different. And as a result of that, we have to focus on what we have jurisdiction for, which is the euro area, taking into account what happens in the rest of the world, but not assuming that what happens in the euro area will be the mirror of what happens in the United States, because we are looking at two different things.
Thank you, President Lagarde. And the next question goes to Martin Arnold from the Financial Times. Martin.
Hello, President Lagarde. Two questions for you. First, to return to the theme of transatlantic divergence. If this divergence on monetary policy that is expected
materializes, does that mean that the ECB is likely to have to ease policy more because of a spillover from the US, tighter financial conditions from the US? Or does it mean that you're likely to do less because of foreign exchange markets potentially putting upward pressure on inflation in the euro area? Second question is on energy markets. We've seen a roughly 10% increase in oil prices in recent weeks. How big a concern for you is that? And could that derail the potential rate cut in June? Thank you.
Thank you very much for your two questions. And in many ways, you've answered the first question, or you at least gave me the elements of my answer to your questions. We are data dependent. We will operate meeting by meeting, and we will take into account all the data that actually matter and how they unfold and develop and affect our economy. As a result of that, I cannot pre-commit to any route for easing more, easing less, unless and until we have the data and we can analyze the data. So that will take its course as the events unfold. And as I said, I'm not going to speculate on the monetary policy stance and decisions of another central bank. Thank you for your second question on the energy market. There is one particular segment in the monetary policy statement that I wouldn't want to let go unnoticed, because I think it's important, particularly in relation to energy prices. And that's the portion that relates to inflation. And I'll read it again for you. Inflation is expected to fluctuate around current levels in the coming months and to then decline to our target next year, owing to weaker growth in labor costs, the unfolding effect of our restrictive monetary policy, and the fading impact of the energy crisis and the pandemic. A lot of those fluctuations that we refer to in that particular paragraph will actually be associated with the very low energy costs that we had in 2 episodes over the course of 23. And obviously, the price of energy, as we see it unfolding in the weeks and months to come, will have a bearing related to that base to which prices are compared. So inflation decline, which we have observed so far, are not going to be linear, and we will have fluctuation around current level based on our projections until it declines to our target in mid-2025. And energy prices obviously will matter in that respect.
Thank you, President Lagarde. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you. Thank you for the opportunity. I have one question about the ECB not pre-committing to a particular rate path, but could we still count on a path of seasons? For example, going from a restrictive season to what you said in the past could be the gradual normalization process. And my second question is on TPI, just because maybe there start to be some small tensions in the markets as several countries may qualify for excessive deficit procedures. What is the impact of this event, if any, on the transmission protection instrument eligibility, as the first criteria of this eligibility does mention the excessive deficit procedures? Thank you.
Thank you very much for your two questions. The ECB is a bank of all season. And I don't think that we can be tied to any particular season. We will be data dependent. And if the data continue to move in this the direction of the disinflationary path that we see, then progress will be continued as well in the path that we adopt. But this is going to be data dependent, and that is the reason why we state very clearly in the monetary policy statement that we are not pre-committing to a particular rate path. But the direction is rather clear, but there is no pre-commitment to any particular path, and it will all depend on the data that come about. Now, on your TPI question, there is a very clear press release that we have posted, and that stands, which I'm not going to comment upon yet again. But the excessive deficit procedure is one of the components, of the 4 components, that we assess when we determine eligibility. And it's an alternative condition that is indicated in that particular segment, which is taken into account, will be taken into account by the Governing Council. So I think you have the answer right there.
Thank you, Madame Lagarde. The next question goes to an online participant, and it's Jean-Philippe Lacour of Agence France-Presse. Jean-Philippe, please.
Yes, can you hear me?
Yes.
This time, perfect. Yes.
Fantastic. I have only one question because all the other ones were already asked, and it refers on budgetary policies. As you know, Germany is already pursuing a restrictive budgetary policy, and Italy and for sure France will also have to do, given their public deficits larger than expected. So it's a bit different question than the previous one, but would this situation of restrictive policy offer a reason for the ECB to maybe accelerate future rate cuts? That is my question.
Well, thank you so much for your question. And on fiscal affairs, I'm going to limit myself to the comments that we included in the monetary policy statement, where we indicate that government should continue to roll back energy-related support measures so that disinflation can proceed sustainably. And of course, we then say that implementing the EU's revised economic governance framework fully and without delay will help government bring down budget deficit and debt ratio on a sustained basis. We had the privilege of Valdis Dombrovskis being with us during the Governing Council meeting this morning. And I think all governors were very pleased to hear him confirm that the revised economic governance framework will be put to a vote to the European Parliament before the end of their session, which I think has another 2 weeks to go. So this is good news to the extent that there will be a framework within which governments are expected to operate and which will be guiding principles and helpful from our monetary policy standpoint. Thank you.
Thank you, Madame Lagarde. And the next question goes to Carlo Boffa of Politico. Carlo, please.
Thank you very much for taking my question. Good afternoon. First question I wanted to ask you is that services inflation is still very sticky, as flatlined for the last 5 months, and the underlying momentum is now accelerating. So would you say that the ECB could theoretically still go ahead with a cut in June if services inflation sticks at around 4%? And my second question is if you can give us a bit of color of the discussion within the Governing Council around the balance of risk surrounding inflation. Some of your colleagues have suggested that the balance of risk are now more balanced. Where do you stand? Thank you.
So thank you for the 2 questions. On your first question, you are right, and I think we point out very clearly in the monetary policy statement that services inflation is still holding at high levels. It has been at 4% for the last 5 months. Domestic inflation, which comprises a lot of services as well, is at 4.5 and has been there for the last 3 months, if I recall. And this is a segment, and those are numbers and indicators that we're going to monitor very carefully. that we will look at very carefully. The momentum is something that we will be also very attentive to. But we are not going to wait until everything goes back to 2% to make the decisions that will be necessary in order to make sure that inflation returns to 2% sustainably at target in a timely manner. So it's inevitable that some items will be slightly higher, and we know that, for instance, if you look at the disaggregation of items, goods, for instance, are at, I forgot whether it's 1.7 or 1.1, but it has gone down. It's 1.1, it was 1.6 in February. So it's inevitable that some items and some segments will be at higher levels, and we will look at all of them to make our determination and to decide whether, on the basis of that assessment, we are confident enough. So that's the first point. Look, on the balance of risk, I know one or two governors who are keen on this balance of risk concerning inflation. But we've always tried to stay away from that in relation to inflation, historically. Historically, we have determined whether it was to the upside, to the downside, or broadly balanced or broadly balanced, in relation to activity, not in relation to inflation. And what we prefer to do, as a matter of principle, is identify those components that will be bringing an upside to the risk and those that will bring a downside to the risk. That's what we have done repeatedly in the monetary policy statement. We do that yet again. And, you know, when you look at the level of uncertainty around, it's probably the right approach to do so in relation to inflation.
Thank you, President. And the next question goes to Stefan Rechius of Handelsblatt. Stefan, please.
Thank you for the floor. One question is a follow-up on the oil prices. How much of an upward concern is that when it comes to inflation going forward? And my second question is on the BLS, the bank lending survey that you mentioned. What is your main takeaway from that? Is it that there is less demand by companies, or is it more that mortgages and consumer credit has picked up a bit? Thanks.
Well, thank you very much for your two questions. On the oil prices, it has increased, as was said by one of your colleagues, by 10% in the most recent weeks. And it's obviously an item which matters a lot. We have learned from the recent shocks that energy costs play a significant role, and we are very attentive to those evolutions. We are largely informing our assessment on the basis of futures. So we look at how futures evolve as well. It's not just the price of the barrel of Brent that we look at. We also anticipate, try to anticipate as well as is possible, and it's not perfect, but we try to use futures as an indicator of where the markets are seeing prices of oil for the future. Thank you for your second question, because it's the bank lending survey is always informative, but it's a survey, and it indicates what the banks assess, assume, expect from their customers, both the corporate customers and the households, the people. Predominantly mortgage and a bit on consumption, but predominantly mortgage. So we have that. And we also have the hard data, which is interest rates that are offered to those customers. And you have the volume of loans on an annual basis. So if you only look at the bank lending survey, what you see is the anticipation by the banks that demand will be slightly lower, both on the corporate and on the household side. If you look at volume, there is a slight, not a major, but a slight uptick in the volume of loans to corporates, and a slight stable compared with the last month uptick in the volume of loans offered to households. And final point, on both corporate loans and loans to households, we have a slight decline in the interest rate that is offered to the borrowers. So you can deduct from that that the financial sector is expecting that financing costs are likely to be smaller in the future. It's the beginning. And in many of those numbers, data, indicators that we have, we see positive development, but it's the beginning of developments. And as I said earlier, in response to the first question, we want to reinforce that confidence that things are going in the right direction, both in terms of growth, but more importantly, in terms of inflation decline.
Thank you very much, Madame Lagarde. And the last question today goes to Andres Stumpf of Expansion. Andres, please.
Thank you. I would like to know what fluctuations on the current inflation number could be tolerated if they come from supply shocks and not from the robust demand. And maybe going again above 3%. And I mean this because, as you have just mentioned, last inflation spike started as a supply shock. And second question, public debt spreads are as tight as I can remember. Are you glad that you could deliver your restrictive monetary policy without creating big tensions, or do you fear that this will incentivize deficits? Thank you.
So on your first question, we know that there will be fluctuation. That's the reason why we put it in the monetary policy statement. We know that we're not going to be a linear decline on inflation over the course of the next months, quarter. But what our projections are telling us is that we will have those bumps on the road, if you will, but with reaching the target in mid-25. So return to 2% in mid-25. Between now and 25, there will be ups, there will be downs, there will be ups. And as I said, a lot of that is related to the base effects that result from the two significant change in energy prices in the course of 23. How much can we tolerate? I think what is really important is the data. It's the overall data. It's the projection. We have embedded in our projection of last March those bumps on the road. It is in there, it's in the baseline. What we need to see is how much away from those bumps embedded in the baseline we are likely to go if we are facing supply shock, as you suggested. But bumps will be there, it will not be linear. Bumps are embedded in the projection of March. We will take stock of that in June as well and update our projection at that point in time. On your second question, and given that you are the last question, and without being triumphant and without celebrating anything yet, but what we are observing, and what we are observing is a decline of inflation, a disinflationary process that is in progress, that is comforting us that the monetary policy that we have adopted so far has contributed significantly to this, and that we will continue to operate on the basis of the three criteria that I have mentioned now several times, which are in the monetary policy statement, being particularly attentive to wages and the evolution of wages, which constitute a large contributor to services, close attention to profit, to make sure that unit profits actually absorb as much as possible the wage increases that will inevitably happen. And we will also continue to be very attentive to productivity, which is also something that we expect will improve in the course of 24. With that, thank you very much.
Thank you. Thank you very much. That brings the press conference to an end. The next press conference is scheduled for the 6th of June. Up until then, all the best. Thank you very much.
This is Bloomberg's The Open. I'm Anna Screening in for Jonathan Farrow, the ECB President Christine Lagarde there, just finishing her press conference in Frankfurt. And perhaps the most prescient line there is as she closes. We're not celebrating, but the disinflation is in progress. The Fed don't have that. They have supercore rising. Markets look like this in the very first flush of the opening bell. Equities managed to regalvanize themselves from a pretty bruising day yesterday, the second worst CPI reaction in US equities that we've seen since 2022. So there is some reprieve. The likes of NVIDIA had actually, ironically, a very good day yesterday, up 2%. So we are just seeing hangout in tech if you want a little bit of a defense there. The producer prices come in on the month a little bit better. We'll get more from Mike McKee on that in just a moment. The NASDAQ up 0.3%. Yesterday you saw Microsoft down over 1%, Apple down 1.33%. Roll it over and have a look. There's NVIDIA at the bottom of your screen, up 0.2% at the moment. The euro, in the very first instance, wants to focus on the optimism. They are preparing the groundwork for rate cuts. The dynamics of underlying inflation, the strength of our monetary policy transmission, that's what invoked that drop in the euro. Of course, she made it very clear, Madame Lagarde, is that the Eurozone has a different set of inflation dynamics to that of the United States of America. Roll it forward, and let me just show you what's going on in the bond markets. Again, they are not celebrating at the ECB, but the disinflation narrative is in train. This is a small drop in yield. Don't forget, we had a global bond market right yesterday on the back of the CPI in the United States of America. I mean, literally, risk was ravaged, and there was a wholesale sacking of risk in the bond market. President Christine Lagarde weighed in on the ECB's latest rate decision.
The dynamics of underlying inflation and the strength of monetary policy transmission were to further increase our confidence that inflation is converging to our target in a sustained manner. It would be appropriate to reduce the current level of monetary policy restriction.
From that news conference, Lizzie Burden joins us from Frankfurt. Lizzie, it sounds as if Madame Lagarde was indeed sticking to trend. They're not celebrating. Disinflation is in progress. It was a much more robust narrative. We're carrying on and still hopeful for June rather than stepping back.
Indeed, Manus, and Christine Lagarde has just walked past me after the press conference. Look, there are a few key questions that we wanted her to answer today. We wanted to know whether there's going to be a rate cut in June. Surprise, surprise, she says it's going to be data dependent, but she did let on that actually there were a few members of the Governing Council who were ready to cut today. The next question, what's the impact of that hot US CPI reading on the ECB's thinking? Surprise, surprise, she told us that the ECB makes up its own mind, but other central banks' policies do feed in through various channels. They can't ignore that, but she was trying to appear unfazed. Third question, what if you cut before the Fed? That leads to euro weakness, and that feeds back into inflation. She doesn't want to comment on the exchange rate. She says that they don't target the exchange rate, and she's not going to speculate on other central banks' policy. Again, she says we're data dependent. So this is very much what we expected, both in terms of the decision today and the communications around it. But what has happened, Manus, today is the ECB has laid the foundations for a cut. They've sent the clearest signal yet that because inflation is retreating, they will be able to cut at some stage soon. And crucially, the policy announcement had the change in wording on the outlook for rates to say that if current trends continue, it will be appropriate to ease, but they're not committing to a particular rate path. So we wait for more data, but it seems, even if she doesn't admit it, that divergence is ahead, Manus.
It is, and that policy divergence will be manifest in the transmission mechanism through the currency. That's what Allianz were saying to us this morning. Lizzie, thank you very much. Lizzie Burden at the ECB. Let's have a conversation now with JP Morgan's Priya Misra and Winnie Caesar of Credit Sites. Ladies, thank you for being with me. Priya, to you first of all, I had a guest this morning saying the ECB has themselves in a bit of a pickle. But Lagarde was very, very clear there that they're not celebrating. Disinflation is in progress. The ECB, it would sound, is in more of a ready to lock and load and go in June than the Fed. Good morning. Is the ECB in a pickle?
I don't think so. I think they're looking at the fundamentals of the Eurozone, both growth as well as inflation. They're seeing, or they have confidence. I think the key question is confidence. The Fed's confidence is probably a little lower after yesterday. But nothing really changed from the ECB's point of view. And I think it was interesting at the end of the press conference, Lagarde said there are going to be bumps along the way. It is something that they have factored into their forecast. So I think the ECB is saying it doesn't need to be a straight line down, but as long as they have confidence that wages are heading lower, that corporate profits can absorb some of that, they can start the process. I think the key question is, they can start the process. The pace of rate cuts will obviously be data dependent, but I think they're telling us they have enough confidence to start the process. So I don't think that they're in much of a pickle here.
Winnie, good morning to you. Good to see you. It's very interesting. You're right, Priya, using the word bumps. In other words, our models are ready for bumps. I don't know whether it was a little bit of a jibe at the Fed. Perhaps they're not just as prepared for bumps in the road. But Winnie, from the European perspective, it does look and sound like, unless there are material bumps, that they will go earlier, and they pretty much need earlier and bigger size cuts than the Fed.
Yeah, it seems that after today's press conference, the ECB is poised and ready to begin to move towards a more loose monetary policy, or at least one that is creeping closer toward neutral, which we don't necessarily disagree with. Now, we still have some hope that the Fed is also going to be able to go in June. We think some of the headline data have made things appear much stronger than the kind of underlying fundamentals would actually indicate. So we're holding out hope still for a more coordinated policy easing cycle across the ECB and the Fed.
Well, the euro now coming back to 107.40. Priya, I just want to quickly tuck this away before we talk to Mike about the PPI. You are still a buyer of this spread. You're a believer in the transatlantic spread in bonds to Treasury.
We are. I think, the fundamentals of the Eurozone, of ECB policy sort of tells us that it's going to be harder for bonds to sell off much. Treasuries, on the other hand, I mean, after that CPI report, the data is mixed. And we still have this fiscal issue. So I think if you were to buy duration, Europe's a better place to buy duration, but I'm getting closer to thinking about buying some US duration as well, probably closer to 460, 475 on the 10-year.
We probably need another little bit of a drive-by in the bond market before we get there and get you in. Ladies, stay with us. Let's just reflect on some of the data we've had this morning on the PPI. Mike is with me in the studio. So it wasn't as brutal in the PPI as it was in the CPI, but to what extent do I extrapolate the PPI to PCE?
Well, you can extrapolate it because a lot of the PPI goes into the PCE numbers. And of course, we're talking about two different measures of inflation, PCE being what the Fed follows, PPI producer prices here. And the theme today seems to be that it wasn't any worse than we saw yesterday, so we can celebrate a little bit. We saw the month-over-month figures come in better than expected, up 0.2% for the core and the headline. Year-over-year, base effects come into play, and so we did see an increase in the year-over-year numbers, but as long as those month-over-month numbers are showing progress, the Fed will be relatively happy. And we can show you the situation with the various inflation indicators. I've got CPI, PCE, and PPI there, and you can see how they all used to track, but now they have diverged coming out of the pandemic. And that makes life a lot more difficult for the Fed to draw conclusions about what's going to happen, because what you're looking at is a PPI that has been much more elevated and a CPI that is drawing closer to PPI. And this is normalization. This is the relationship between them, not the actual levels of inflation. But the PCE has remained well below both of those. So the problem the Fed has is that the markets and the public are looking at CPI, and it is PCE that will drive the Fed. So there may be some disassociation involved in what we hear from Fed officials going forward. Now, the other thing that came up this morning is markets have really priced divergence in terms of various central banks. We're still looking at one rate cut from the Fed by the end of this year. The Bank of England 2 rate cuts, and we had a Bank of England member say today that was crazy, and then 3 now for the ECB. All this will play with currencies, and of course, Christine Lagarde did not talk about that, but all of this will matter down the road as these central banks try to figure out what they're going to do and the knock-on impact. So it's going to be very interesting going forward to see what data we get, how inflation performs, if it turns around in Europe as it has in the United States, if it maintains that in the United States. But for today, looks like markets are happy because it wasn't worse.
Indeed, a little bit of relief. Priya Misra and Winnie Caesar are my guests. So here we are. Yesterday we saw a wholesale vortex in the bond market because suddenly the door was slamming closed to a June rate cut. There was talk even maybe of no rate cuts. Winnie, you believe that the data does not preclude the Fed from cutting in June. So therefore, are you expecting some kind of massive turnaround in core CPI?
Well, what we're expecting is a continued normalization. When we look at the components of core CPI that overshot expectations, we still have shelter and then transportation services really leading the charge. And I guess thinking back to whether those are going to be reoccurrent drivers of sticky inflation, we don't think that they're going to be. And if anything, the transportation services, which is largely motor vehicle insurance, acts as another tax on consumers, which is particularly tricky when you also have elevated oil prices. And so we do think that there will be continued normalization on the inflation side of things. And we haven't been expecting just this straight line back to 2% on core. And we think that the Fed does have some latitude to start to move just towards a very less restrictive, not necessarily accommodative or even neutral monetary policy over the coming months.
Priya, the talk in the market is now non-negligible risk of 0 cuts 2024. Of course, we overreach. That's what markets do. They overreach. They become too exuberant on the bid or the offer. How real is that risk, and how real at all is the tail risk of a rate hike? And what would that do to the bond market?
So I think if you listen to Fed officials, there's really nobody talking about rate hikes.
Just
but
Larry
I do
Summers.
get concerned. I do get concerned that if the market starts to price in absolutely no rate cuts this year, then you should put in a probability that they might hike. So I think that's why it's important. Where do they cut in June, July, September? Actually, it doesn't matter all that much. Do they cut at all? I think that's the question. One of the things I'm also keeping a very close watch on is wages. We know service inflation is sticky. We know service inflation is extremely linked to wage inflation. Despite these very strong payroll reports, we've had wages actually continue to moderate. The supply side of the labor market is helping equalize the fact that you've had these 250,000 payrolls and yet wages are moderating. If wages continue to moderate, and we're seeing 0.3, 0.4 month over month, I think, and I would say inflation expectations remain anchored, which have been remarkably anchored, I think the Fed can still guide towards rate cuts. Maybe it's 2 instead of 3 or 1 instead of 2. I think that actually matters less. If you do start to see the Fed starting to talk about no cuts, then I think the entire soft landing narrative is at stake. So, I think we always struggle with the economic outlook or the reaction function. I think the economic outlook is giving us a mixed picture. Mike talked about it, Winnie talked about it. You look at the details, parts of it are heading lower, parts seem bumpy.
Okay.
But let's now see the reaction function. So far, I think the Fed's saying we're at restrictive territory. Let's start the process of normalization. As long as they continue to say that, I think we'll price in 1 or 2 cuts this year or 1 cut this year. And I think then the soft landing thesis can persist.
Well, that supercore needs to really, really roll over. My favorite line of the day is from RBC. The rickety dam holding back the no landing narrative may be at stake. So we'll convene again in a month's time and do it all over again with a little bit more data and insight. Priya Misra, Winnie Caesar, my guest this morning on the ECB and the bond markets. Coming up, tensions heat up in the Middle East. Oil prices jumping nearly 20% in 2024. That conversation next with Will Kennedy on Bloomberg.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or you know, Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up, you know, quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We also want to address the Iranian threat to launch a significant, they're threatening to launch a significant attack on Israel. As I've told Prime Minister Netanyahu, our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
Oil is swinging near the $90 mark. That's after a pretty tough couple of sessions. We're preparing for a whole host of functions. Traders are watching as the U.S. warns of a major attack on Israel by Iran or its proxies. Global tensions have driven the oil market up 18% this year. Will Kennedy joins me now. Well, the market has rolled down since you and I caught up this morning. We don't know what the response mechanism will be from Iran. Is that, along with a tight market, driving this market? How comfortable is OPEC with these prices? Good morning.
Hi, Manus. Thanks for having me on again. I think the market is characterized exactly like you say, by tight fundamental supply and demand, a strong economy, especially in the US, which is driving demand higher, combined with some tight control of the market from OPEC and some other supply disruptions around the world. And on top of that, you've got a layer of political risk. And that's really what's driven this rally, which, you know, if we think back to the beginning of the year, very few people in the market foresaw there was a real bearish mood in the market, but we've seen, as you say, a significant rally. So it's that combination of the two. What happens from here, you know, there will be a lot of concern from traders that this situation between Iran and Israel, while it isn't currently a threat to any production, and the war in Gaza hasn't taken any production out of the market, although it has disrupted shipping in the Red Sea, is that it escalates to a point where Iran gets drawn into a regional conflict, and there is some impact on oil exports from the Gulf region. But I would stress that that's a long way off, but it's a risk that the market does need to be aware of.
Indeed, and as you and I said this morning, the reaction function from OPEC Plus in June will be all the more pressure. And indeed, they all have the capacity, not all, but certainly Saudi and the Emiratis, along with a number of others, have the capacity to add back pretty quickly. Well, thank you very much for joining me this morning. That is Will Kennedy on the oil market. Price action going on in these markets. Katie Greifeld is on set. Katie, what have we got?
Well, it's a pretty even split if you take a look at the sector level right now. You have 5 sectors in the green, 6 in the red. Leaning the way to the upside, you have communication services and tech, of course, up about 0.6% a piece. You take a look at what's not doing too well. You have energy, you have healthcare, and then you have real estate. Real estate down by about 0.2%. Financials leading the way, rather, to the downside. But let's talk about real estate, because this is part of a trend here. Real estate is your worst performing sector on the week, as you can see right there, over the past 4 days, off by more than 2%. Of course, really interesting moves in the bond market as well. Perhaps that's working its way into the real estate sector, Manus.
Katie, thank you very much. Coming up, the market moving events to set your clock by, the trading diary on the way.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg.
We've managed to put a little bit of calm into these markets. NASDAQ rebounded by 0.4%. Again, day two, NVIDIA, even though the equity markets took pressure and a sell down yesterday, NVIDIA was up nearly 2%, continues to rise this morning on the back of Bank of America reaffirming their call on that. Russell 2000 up by 0.2%. The PPI just wasn't as brutal as the market had anticipated. Look, we're going to continue with Fed speak today. Barkin, Collins and Bostic all delivering remarks. We count down to the earnings for JP Morgan, Wells Fargo and Citi tomorrow. On Monday, it's Goldman Sachs. They will deliver their numbers. The fresh economic data, including the retail sales, hits the tape. Finally, Tuesday, it is more bank earnings. Bank of America, Morgan Stanley. That was Countdown to the Open, right here on Bloomberg. Good morning.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney, we're live here, and we are streaming on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. This is Bloomberg Intelligence. We focus on company stocks, bonds. We lean heavily on the over 400 investment professionals at Bloomberg Intelligence, which is Bloomberg's in-house investment research department. They cover over 2,000 companies, 130 industries all around the world, and we tap into their expertise. So we're going to do that as well. Today, we're going to take a look at that inflation print. Got a PPI data that came in a little bit more in line with expectations on the back of that hot CPI data. Markets digesting all of that. We kind of got a mixed screen on the screen right now. Let's go to John Tucker and kick this whole thing off with the Bloomberg Business Flash, John.
All right, Alex and Paul, Interactive Brokers is our sponsor. Interactive Brokers discover the future of trading with their next-generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. Major stock averages mixed to a little change right now. For the 11 major industry groups in the S&P 500, higher right now. Information technology, that is in the lead, and that's where you're going to find semiconductor stocks like NVIDIA. It's up close to 1%. After yesterday's surge in yields, two-year Treasury yield, that is lower right now. This is the more policy reactive. It is down 3 basis points. It comes after several categories in the PPI report that are used to inform the Fed's preferred inflation measure. They came a little softer today. Still, Manulife Global Chief Economist Francis Donald thinks the Fed is quickly running out of options.
We do believe there is downward surprises for growth ahead, but they're not quite here yet. And this is what the Fed has to contend with. In the near term, inflation, we think, is going to continue to surprise to the upside, and the Fed won't be able to cut. They're going to lose the data support to cut in the near term.
And right now, the S&P 500, 5 points lower. That's down 0.1%, 51.55 on the index. The Dow Jones Industrial Average down 112 points. The NASDAQ 100 right now is higher. That is up 42 points, up 0.25%. Some of the individual shares on the move. Let's do CarMax. Those shares are down 12%. The used car dealer reporting net sales and operating revenue for the fourth quarter that missed the average analyst estimate. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. May I just say, your hair looks lovely today.
Exactly. I was thinking the same thing
Weren't you
today.
thinking the same thing?
I was, exactly.
Okay.
How's
He's
mine?
throwing shade at me because I had to face the elements after makeup did my hair today, and the elements did not do good things to my hair. That's
And
it's
John and I
messing
were
with
just
me.
saying, I mean, what do we have to do with our hair every day?
It's intense.
You know, we just did.
I
we
barely
do the
comb
best we
mine.
can.
You should have heard when John Tucker was on the afternoon shift and he had to wear makeup. You should have heard him complain about that. These guys got nothing on me. Happy Friday Eve.
How come we don't have to wear makeup in the morning?
I do.
But we don't. But I know in the afternoon, like Tim Stenovic does.
Because they're on TV. Because, I mean, I
they
know
do
we're live on...
simulcast. I see.
Yes.
Okay, I got you. Okay, very
Yes.
good. All right, let's get back to the important stuff.
Hey,
PPI,
man, my hair is
PPI today?
important. PPI, nothing burger.
Nothing burger, very good.
Which
Okay.
is good, right?
Yep.
I think we wanted that to be the case. And then it's, I don't know, now it's earnings.
Now it's earnings, and tomorrow we kick off earnings, so I'm going to take the day off tomorrow. So, all right, let's go to Vince Signorella. He doesn't take any days off. He just doesn't come into the office. Vince Signorella, Bloomberg macro strategist, joining us from the financial capital of Westchester County. Zoom from White Plains. Hey, Vince, boy, that inflation print, I guess from the bond market's perspective, was something. What did you make of the inflation print and kind of what it means for our Federal Reserve?
Well, I think what the market's waking up to now, and you can see it, I think we're seeing some higher yields and a sell-off in equities, is one of the components that the BLS reported as helping that PPI number come in a little tamer than the markets expected were energy. But the energy data is seasonally adjusted. So if you look at real energy prices, they're actually higher. So this is a bit of a mirage that the BLS is throwing us today as to why that PPI number is lower. And I think that's what the market is waking up to. When you look at real inflation, real energy prices, gasoline futures and crude futures, they've been going up, especially since the beginning of this year. And I think that's what the market is seeing now, and I think that's why we're rolling over. If we get into if we end up with a red tape today, that's going to be very bad for risk, and it looks like we're going that way.
Hey, Vince. I love Vince.
Don't we
so
all?
when I had the morning show from 7 to 9, he would wake up every morning and come in every morning to be there for the top of the 7. That was my guy. Vince, when you talk about sort of negative for risk assets, how negative for risk assets? Like the Nasdaq's still up by 0.2%. The S&P's only down like 0.1.
Yeah, but I think if you take it all in, and we're seeing it coming from Barkin's making comments right now about labor market strength, is making the case that we're not in a recession and that we're going to be pushing back on rates. You look at the serious, the big boost in job numbers on Friday. We've now got 3 months in a row of hotter CPI. Powell can no longer look at January and February and say that was an aberration, it was seasonal. When you get the third month, and now who knows what's going to happen April, May, and June. More likely than not, that trend is going to continue where we're going to see higher inflation. And I personally would argue that we're not going to see a rate cut this year at all. We've talked about that, Paul and I guess, on a previous show. I just don't see, when you've got strong job growth, strong economic growth, and inflation bottoming to perhaps getting a little perky and moving higher. I have never seen a Fed cut interest rates in that environment in over 50 years, and I don't think I'm going to see it this year either. So when I see the risk to risk assets, we're seeing it modest today, but I think it's going to accelerate as we continue to see data which suggests the Fed is going to keep pushing interest rate cuts out, and a lot of, I think, these gains are predicated on that. Now, earnings can help it turn all that, absolutely, no problem. But Whether they will be enough to sustain a rally against a Fed that's potentially not cutting rates remains to be seen, I think.
So you calling for no rate cuts this year, that, you know, I'd say that's still the minority, Vince, although Torsten Slok over at Apollo has a similar call here. I mean, if we don't get something in June, I guess that'll become more credible or more, I guess, justified call. Is June an important meeting for you?
Not to me any longer. I think it is for the likes of Goldman Sachs and Morgan Stanley. They're still looking for 3 rate cuts, and frankly, I don't see how they see that at all. I think a lot of people have now pushed it out to September, some even actually out to October. I mean, when you start to push rate cuts out to September and October, it's relatively impossible to get 3 rate cuts in this year. And so the 2 biggest investment houses, Morgan Stanley, Goldman Sachs, is still making that call, and I just think they're wrong. We also get the pressure from the presidential election in November. Powell's going to want to stay and to assert the independence of the Fed. He's going to be very, very careful of making interest rate moves around a presidential election where either party could suggest he's favoring the other side, and that puts Fed independence in jeopardy. When he did that 60 Minutes interview, the mic drop moment for me, and I think most, was how he stressed how important it was for the Fed to remain independent. And I think you have to take that election into account when it comes for timing of rate cuts or any rate move at all. And if we push out the summer, that makes 3, even maybe 2 impossible. I still just don't see one if the data continues in the way it's going.
Hey, Vince, before I let you go, in your former life, you were an FX trader. 153.17. Did you think we were going to see something like that without some massive intervention?
I think the move has been very, very gradual. So the BOJ sitting on the sidelines on the moment. Well, I mean, in terms of intraday volatility, you know, we saw some definite. There were a lot of orders at the 153 figure yesterday, which is why we saw that little bit of a spike once it broke through. There were option protection hedges and such. I still think we see the dollar higher. I still think we see dollar yen higher. If we start approaching 155, which I think is a real possibility as we see that interest rate divergence continue between the U.S. and perhaps the central banks of the BOJ and ECB, we will test that 155 level, and I think we will then probably wake up the BOJ, or I should say the monetary authorities in Japan.
Wow. All right, Vince, thanks a lot. We really appreciate it. Wonderful to see you broadcasting from your basement. We always appreciate it. Vince Signorella, Bloomberg macro strategist, joining us. Apparently, Paul, Amazon had a letter out today.
Yeah, this is something new.
Is that a thing we do?
No, I think we start doing it now with Mr. Jassy.
Okay. I mean, do we care about Amazon letters? Is that something that, I don't know.
They're so big, and it's retail. It goes to the consumer. They're a tech behemoth. They're now a huge advertising play. So I think the answer is yes. And so let's check in with an expert. Poonam Goyal, senior U.S. retail analyst for Bloomberg Intelligence. She joins us from our Princeton offices down there in the swamps of New Jersey. Poonam, what did you make of this letter? I mean, I think Mr. Jassy is trying to just make sure that the market doesn't take its attention away from the fact that Amazon is, in effect, an AI play.
That is part of the story, definitely. I think the focus on the letter goes into all its businesses, starting with retail, where they continue to push the envelope on value and driving that GMV higher through its logistics platform, where they're improving same-day delivery and really taking costs out of the equation as much as they can. On the AWS side, AI is the name of the game, and they want to make sure that they are visible, that they are playing in that space, and that is going to improve every part of their business, not just AWS alone.
So, but in terms of AWS, it feels like what they were saying is that AWS is going to be the foundation for all the AI plays. Am I reading that correctly?
Yeah, I mean, you know, where AI is built is going to be inside of AWS for Amazon. They're going to be building, or you could call it the raw materials of the codes, and really providing that as an entry point for businesses that use AWS and even within their own businesses to create the efficiencies and the speed that's needed to operate in the agile environment we live in today and compete with OpenAI.
You know what I've learned since moving down to the Jersey Shore is central New Jersey and southern New Jersey is like a warehouse capital of the world, it seems like. Everywhere you go, and Poonam lives around there.
Is it all Amazon or just in
it's
general?
everything. It's everything, but tons and tons of Amazon, because you got the park, the Gardens State Parkway, got the New Jersey Turnpike, Philadelphia Port, New York Port. I think it's all there. It's just amazing. So, Poonam, I mean, talk to us about, do investors that you talk to, do they still want Amazon to invest aggressively in their retail operations there? Is there more to go there? And do investors, are they okay with that, given that maybe some of those dollars could be to the cloud, or maybe Amazon has got so much money they can invest in anything they want?
I mean, I think they need to invest in both the cloud and retail. I don't think you want them to stop investing in retail, because remember, Paul, as the retail business grows, which we estimate the GMV to grow to $1 trillion in the next coming years, that impacts their advertising business, right, which has grown to nearly $50 billion today. The bigger retail gets, the more money they can get for advertising too. So there is a connection here, and that's how retail is made profitable.
What also is interesting, aside from retail, is what they said about their Amazon Prime video. They seem to think it could be its own standalone, like good enough to live on its own. What did you make of that?
I thought that was interesting. You know, Amazon Prime Video, we know that it's something that they've been investing aggressively in, but I think the game changer here really is going to be advertising again, where as they implement ads within the Prime videos, that's what's going to take it to be profitable, whenever that is. We haven't run the model yet, but we think there's still a bit of time before you can say that Prime Video on a standalone entity is going to be profitable.
Paul, did you do Prime Video?
I'm going to just say yes. I mean, you know what I do periodically, and maybe I'll do it on the plane ride down today, is I just go through and I delete them all. You know, just periodically I go and just delete, like, I don't need this right now. I mean, you know, because it's so easy to delete these, as opposed to trying to disconnect from Verizon or Comcast, which takes like half a lifetime to
That's true, 100%. And
Yeah,
then there's
totally.
weird fees and it doesn't work and the whole thing.
Hey, Poonam, what's the investment call on Amazon these days? I'm looking at the stock here. It's up 22% year to date. It's up over 80% over the trailing 12 months. So it's really performed well. We're just under $2 trillion in market cap. When you talk to investors, kind of, why do people own it today? Why do people buy it today?
Well, we think it's all about profitability. For the longest time, for over 2 decades, Amazon was about market share gains and top-line gains. Today, we're starting to see the story turn into a profit play. So as AWS climbs to over $200 billion in revenues, which we expect, as the GMV for its online business climbs to over $1 trillion, and as advertising gains scale to over $100 billion, you're talking about the profitability of this company improving vastly. Just last year, the profits improved to about over 6% from 2% the year before that. So we're starting to see that play out, and we think the road ahead is still very clear in terms of how they parse out their way to be even more profitable.
Poonam, before we let you go, usually the reason why we like the Jamie Dimon letter is because we get really great macro reads and like calls on rates and opinions about the Fed. Did we get any of that from for Andy Jassy in terms of like consumer outlook, how their end user, how I'm doing in the market?
Well, they talked a little bit about value and how they continue to really focus on low prices, which they had done in 4Q with Prime Day. And they also launched earlier this year a Spring Day sale. So we do see that push on value, which tells us that the consumer cares about prices. So they are being sensitive to that and responding to that. And we don't expect that to change as the year unfolds.
I tell you, if I were an investor here, it'd be for this reason. Free cash flow in 2023, $32 billion. Nice. Wow. How about 2024? $63 billion is the forecast.
Oh,
and in 25, $83 billion of free cash flow. So growth in free cash flow. Poonam, what do they do with the free cash flow?
They're going to invest it back in the business, right? As you said it, they still need to invest in AI, they need to invest in AWS, and they need to invest in logistics. So that will be the primary drivers of their cash investments.
But how, I guess, is the question, right? Like, they can't go buy stuff, can they? Because of all the regulatory scrutiny over big tech in that way? I mean, they can't just go buy TikTok, for example.
No, I don't. I think it'll be much harder for them to make an acquisition. They have to grow organically, and they have to invest in their own businesses. That said, there's plenty of opportunity for them to invest in what they own, whether it's across advertising, Prime Video, their retail business, and AWS. There's still a long runway for them to go. Digital commerce alone is just at 25% penetration in the US and probably a little over that globally. So there's opportunity across all of their businesses, even their biggest business.
Yeah, I mean, they're spending, $60 billion a year in capital expenditures, so it's not like they're,
not doing anything.
Yeah, exactly. All right, Poonam, thanks so much for joining us there. Poonam Goyal, Senior U.S. Retail Analyst for Bloomberg Intelligence, joining us from our studios down in Princeton, New Jersey. Something I just saw the red headline here. Harvard.
Yes.
Got to take the SAT to get back into Harvard these days, starting with their fall 25 admission. So a lot of the Ivies and a lot of other schools that had kind of suspended the SAT, in part because of the pandemic, in part because maybe it was biased, are now bringing it back. And I'm just so thankful that my last child, who's now a freshman, we did not have to go through all of that.
My
so cool.
best friend's husband tutors for these things, so I'm very happy for them that this is going to be working out. There you go, Harvard reinstating SAT testing. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After yesterday's sell-off, stocks right now, they're mixed. The Producer Price Index, that's the latest information we got this morning in terms of data, increasing by the most in 11 months, but it also came in below what economists surveyed by Bloomberg were expecting. Financial shares falling right now. This is actually the worst performing major industry groups in the S&P 500 as the banks get set to kick off the earnings season tomorrow. Google's parent Alphabet leading gains in the mega caps that's heading back toward what would be a record $2 trillion market value. Nike, best performing stock in the S&P 500. A Bank of America analyst raising the sportswear company to buy from neutral. S&P 500, 14 points lower. That's down 0.3%. Dow Jones Industrial Average down 201 points. And the NASDAQ 100, 20 points higher. That's up 0.1%. Let's get the update on the Treasuries. The 2-year yield, 1 basis point lower after yesterday's surge. Right now at 4.96%. The 10-year, that is higher, up 3 basis points. That's at 4.58. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
Thank you so much, John Tucker. I'm Alex Steele with Paul Sweeney. We are live from Interactive Broker Studio right here in Midtown Manhattan. We're also live on YouTube. We cover all the news for you, all the companies you need to know with our top analysts all at Bloomberg Intelligence. They cover 2,000 companies and 130 industries. Can I just add on to the Business Flash for a second?
Yes.
Because I think John Tucker is going to like this company. So Fastenal, that stock is down by almost 6%. It makes bolts and stuff. It literally fastens the things that go into final goods. The reason why it's interesting, they also do safety
It's like a
products.
bellwether?
Yeah, exactly, because it's really tied to end user demand and final production. And it saw that part of their business, because they also make like safety goggles, slow, a weaker demand environment, which doesn't make sense when you look at the ISM manufacturing data. So something's going on here, but that's a nice bellwether to look at.
Located in Winona, Minnesota. $40 billion market cap. Wow.
I thought you were like talking about a shoe company.
You of all people should know that is not true. No, I really like industrials. I think that tells you a lot about the economy. Anyway, tell us a lot about the economy will also be a nice 30-year auction that we're going to get today. The 10-year yesterday did not go well. John Tucker's really into auctions, so he's super excited about it. But you know who is? Ira Jersey. He's a Bloomberg Intelligence chief U.S. interest rate strategist. Ira, there's a lot to get through here. We get that $22 billion worth of 30 years coming out at 1 o'clock. We also continue to digest that sell-off and higher yields that we've seen. You got the 10-year up by 3.9 basis points. What are you expecting?
Yeah, so let's start with the 30-year auction. It's going to be a really interesting test of demand for treasuries at this point. So yes, we're rallying a little bit today in parts of the yield curve, but selling off in the back end. I think part of that's to make room for the 30-year. But will these higher yields increase demand for long duration assets? And if not, I think that can be a pretty bearish signal for the market. So I do think that the primary market today will be pretty important. Yesterday's 10-year auction was just about as bad as you've seen them go. Part of that was because they were trying to sell in the middle of the runoff. You were trying to sell an hour before you got the Fed minutes. All of those things probably conspired to make somewhat weaker demand than you normally have. But you had dealers get almost 25% of that auction, which is the most in over 2 years, or about 2 years. So if we see another weak one, I think that just suggests that we're going to be at risk of continuing to sell off, especially when we have data, at least the high level economic data that seems reasonably robust, like we've had the last couple of weeks.
And that is why auctions are cool, John
Auctions
Tucker.
are cool.
I was looking at the Masters update when you were talking.
He's not even paying attention.
Hey, Ira, my limited knowledge here of the treasury market is I just felt like the 10-year, it's kind of in a range 4 to 4.5%. But boy, here we're up at 4.58%. This is starting to get my attention now. What do I make of this move here?
Yeah, 470 is an important technical level, Paul. So that's the next stopping point because we just broke that 451 resistance, which was pretty important. Well, you make out of it that the fact that the economy is reasonably strong. You have less support from the Federal Reserve cutting, and certainly the market's no longer pricing for as many cuts as we were. And now you even have the market starting to price for the potential that the next move is a hike. So I think I mentioned it to you guys before on the show, but when you look at the options market, we were pricing for 0% chance of a hike this year, went to like 5%, stayed there for about a month and a half or so. Now it's almost 15% chance that there could be a hike by the end of the year. So when you look at the odds and look at the distribution of all the risks, you're now getting toward almost a base case scenario that the Fed might be on hold the rest of this year. And I think that's an outcome that might not be so good for some risk asset markets because a lot of the valuations I think have been predicated on the idea that the Federal Reserve at some point is going to be cutting interest rates, and if the Fed winds up being on holds into 2025, then I think that people have to readjust their valuation expectations for some markets, and that ironically could be supportive of the long end of the Treasury market. But I think generally speaking, it's probably a repricing of risk assets, whereas Treasuries do a whole lot of nothing.
Right. So that's exactly what I was going to say. So yes, risk assets reprice. So therefore, what do you buy in the bond market as a safety? I mean, to be honest, at 4.58% on the 10-year, I mean, is that good value?
Well, so at these types of levels, you need, over the next year, you would need the Treasury market to sell off probably about 50 basis points. So, talk about 5.1, 5.2% 10-year yield for you to lose money in a Treasury. So that's what we call the break even. And with that type of cushion, there are some investors, I think, that would consider maybe buying. But look, you say that for the 10-year, like that seems reasonably fair. It doesn't seem like an unrealistic return expectation for a lot of assets for a long period of time. But think about the 2-year or the 3-year, where the 2-year you would have to have interest rates go up to like 11.5% in order for you to start losing money if you bought a 2-year note at 5%. So you can lock in effectively 5% and not guarantee a positive return, but nearly guarantee a positive return, right? You need to have some absolutely exceptional sell-off in interest rates, right? You need Paul Volcker to be the Fed chair again and hike interest rates to 12% in order for you to lose money. So it doesn't seem like the risk reward in that front end of the curve still seems pretty attractive, even though we've sold off about 25 basis points over the last week in that part of the yield curve.
So, Ira, when you talk to institutional investors out there, what's the most popular trade here?
A lot of people got flat last week, and I think that there's a lot of people who are concerned. A lot of people are they're worried about credit, but long credit, which I think is an interesting aspect. And you look at what happened yesterday, you had a massive interest rate sell-off, yet corporate credit spreads did nothing. You look at investment-grade corporate spreads, they were literally unchanged on the day if you look at the Bloomberg Corporate Index. So I think you're in an environment where people want yield, people are looking for yield, they're looking for ways to kind of outperform the index and their peers, and they're doing that through being selective, buying corporates that they think can weather storms if we do have a pretty serious slowdown. Obviously there's some good sectors in manufacturing that might not be doing great. You mentioned Fastenal. I have to thank them because they were nice to me at a NASCAR race a couple of years ago, and hosting my kids getting pictures with some of the drivers. It was great. But I think that, Alex, what you bringing that up is a good point, because there are sectors in the economy that aren't doing well. So when you're buying assets today, when you're buying fixed income assets, you need to be very selective. And your rate and duration call is important, but your sector allocation call is equally as important as well, particularly if you're trying to manage yourself to an index and instead of just total return.
Right, and that's why a lot of things, 1 + 1 maybe doesn't equal 2 all the time, in that you have the Fastenal versus the ISM manufacturing that I was bringing up. Like, how do you digest that? And like you said, a company by company basis. Before we let you go, real quick, I mean, am I looking for tips? Am I looking in real yields? Like, where's the value there?
Yeah, so real yields, I mean, we've kind of liked real yields all year, and you know, they were really, you know, 5-year tips seemed really attractive, like at 2.2%. They rallied back down to almost 1.5, and then now have come almost all the way back. You know, the advantage of owning tips now is that you'll likely outperform nominal treasuries if inflation remains reasonably high. Because you've now sold off to a point where 2%-ish on real yields, you know, might end up ultimately being the long-term average. You know, people go look back to the 1990s when tips first came out, and they were at 4% real yield. But you know, it was a much different environment. The market wasn't as liquid. So I think, you know, 2% doesn't seem like a bad entry point if you want to consider taking some real yield risk and some fixed income risk in general.
Ira, great stuff. See, he knows Fastenal. He feels me. He gets it.
Yep.
Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. I'm really glad that I'm not a fund manager.
Really?
And having to manage this environment and the confusing signals that we're getting, and then keep delivering without like owning NVIDIA or something.
Right. Well, it's good to be CEO of a big energy company. ExxonMobil CEO Darren Wood's pay climbed 2.8% to $36.9 million.
I'm waiting for my call, man. I mean, come on.
Boy, the CEO pay is just extraordinary here. I mean, you know, everyone, or a lot of folks complain about it, but a lot of these folks, they tie it to stock, and then they get their board to set stock compensation thresholds that are easy to meet, and then they rip it on their stock.
Yeah.
And that's a game that's been going on for a long time, and I guess it works. So
for some.
Good in the energy business today. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, and John. A sweeping Russian missile attack has destroyed Ukraine's largest power plant in the Kyiv region. It's the latest strike on Ukraine's energy infrastructure at a time when Ukraine is experiencing unusually warm weather. Bloomberg's Volodymyr Verbiani is in Kyiv.
One possible explanation for why the Russians are conducting these attacks now is to hinder the acceleration of air defense system supplies to Ukraine from its Western allies.
Bloomberg's Volodymyr Verbiani. Japanese Prime Minister Fumio Kishida is heading to Congress today to address U.S. lawmakers on the importance of keeping a strong partnership between the two countries at a time of tension in the Asia-Pacific. Last night, a White House state dinner was held for Kishida. The Biden administration is issuing a rule designed to close a gap that allows gun buyers to avoid background checks. It targets the so-called online and gun show loophole by expanding the definition of who must obtain a license to engage in firearm sales. Attorney General Merrick Garland spoke in a video provided by the Justice Department today.
If you sell guns predominantly to earn a profit, you must be licensed and you must conduct background checks.
Attorney General Merrick Garland. Michael Bloomberg, founder and majority owner of Bloomberg News Parents, Bloomberg LP, helped found and is the current supporter of Everytown for Gun Safety, which advocates gun safety measures. A Vietnam court sentenced real estate tycoon Trong My Lan to death for her role in a $12 billion fraud case. It underscores the Communist Party's determination to crack down on corruption. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And traders are starting to move their focus to earnings. You have shares of big banks falling ahead of the start of earnings season tomorrow. Financial shares dropping the most right now in the S&P 500. You have investors getting ready to pick over the first quarter results from J.P. Morgan Chase, Wells Fargo, and Citigroup. Inflation still a big part of the picture, though. The Bureau of Labor Statistics publishing its producer price index this morning. Prices increasing in March from a year earlier by the most in 11 months. Though you did have certain categories a little more muted, those categories actually feed into the Fed's preferred inflation gauge. And Robert Socket at Citigroup Global Markets still counting on a June rate cut from the Fed.
This is a Fed that seems to really want to get the easing cycle started at some point this year. So on balance, we're holding on to it. But again, it's going to depend on those next few inflation prints and how the labor market evolves.
Right now, the two-year yield, that's down 2 basis points at 4.94. S&P 500, 9 points lower. That's down 0.2%, 51.51 on the index. The Dow Jones Industrial Average, 198 points lower. That's down 0.5%. The NASDAQ 100 up 54 points, a rise of 0.3%. Among the leaders in the S&P 500 right now, super microcomputer, that is up 2.5%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top analysts with all our top analysts worldwide. They cover 2,000 companies and 130 industries. Here's some news for you guys. O.J. Simpson, former football star acquitted of murder, dies at 76. This came out through a statement from his family that says, on April 10th, O.J. Simpson, our father, succumbed to his battle with cancer. He was surrounded by his children and grandchildren during this time of transition. His family asks that you please respect their wishes for privacy and grace. ABC News reporting that right now.
All right, very interesting there.
An end of an era.
Yeah, what a story, what a multi-layered story over the years.
Do you recall when he was in the Bronco with Al Cowlings and just the national coverage that garnered?
Yep.
Everybody was following that with helicopters.
Yep.
Oh, yeah. Oh, my gosh, yeah.
Yep.
I was, not to betray my age, I was a senior in high school when the trial went down, too. And I remember, everything was done. We had no classes, TV screen, the whole thing.
Yeah.
They allow that in school?
We just had the one TV, to be fair. I mean, it's still the 90s, but...
I was, to betray my age, I was here at Bloomberg watching it in the newsroom and reporting on it.
Okay, so very good. ABC News reporting that O.J. Simpson, former football star who was acquitted of murder, dies at 76. In just moments, Alex, Lisa Abramowitz, Bloomberg's Lisa Abramowitz is going to sit down with Joseph Bay and Scott Nuttall. They're co-CEOs of KKR. I'm going to talk about the firm's plans to reach at least $1 trillion in assets under management within 5 years.
Amazing.
Yeah.
That's a big, big number. They're also reviewing some options to exit IT solutions firm BMC Software. That could potentially be a $15 billion sale. There's a lot to get through on that, sort of how they get to that $1 trillion of AUM. Also, again, how do they exit stuff that's been around? Is the market finally opening up? Torsten Slok of Apollo was saying M&A is rebounding. Like, we finally have capital markets mobilizing here. Also, what is it like to be co-CEOs?
Yeah, especially after the named founders have kind of stepped aside to a certain degree. And the named founders, particularly Mr. Kravis, so huge in defining that industry, creating and defining that industry for, I would say 40 years.
And it's been very hard. It's been really hard for these companies to be able to make that transition. So I wonder what that's like on many kind of different levels. So I'm very much looking forward to this interview.
Yeah, so it should be interesting. Lisa Abramowitz will bring that to you in just moments there. But there's so much capital within these private equity, now private credit firms, so much capital on the sidelines looking to go to work. And it seems like they have no problem raising fresh capital, but again, they need to exit certain deals to free up the ability to raise new funds. So in an exclusive interview, Bloomberg Television's Lisa Abramowitz is on location with KKR co-CEOs Joe Bay and Scott Nuttall in New York City the day after their investor day. Let's take a listen.
Welcome to Bloomberg Radio, Bloomberg Television. I am Lisa Abramowitz here in the KKR offices in Hudson Yards. I'm here with the co-chief executive officers, Joe Bay and Scott Nuttall, after their investor meeting. It was the first going back 3 years, the first in person going back 6 years. You unveiled some incredibly ambitious targets about growing the firm from less than $600 billion in assets now to more than $1 trillion in 5 years without growing headcount significantly in any kind of way. Why is it important to remain small with respect to the number of staff while expanding?
Important to know what your North Star is and what your DNA is as a firm. A lot of what's created our success is our culture. Everybody's connected. People help each other all around the world. Ideas travel, relationships travel. That's allowed us to get to where we are. And so one of the things we're very focused on as we go forward is to make sure that we retain that. But also, as we've been building the firm, the way our business works, you add people before the businesses grow. And it takes 10 to 15 years to get to scale. And what we laid out yesterday is we have the people inside the firm. We've been building these platforms for the last 10 to 15 years and beyond. So the people are here, and we're starting to get to this inflection point. So that's what we've told.
And it raises this question, Joe, about how you maintain a sense of morale and people not feeling overburdened while also expanding assets. And I know that the people are here, but this is something that a lot of companies are grappling with right now, which is you want to scale up, you don't want to lose culture, you don't want to get too big, you don't want to have too many middle managers, and yet people are getting exhausted. So how do you prevent that kind of development?
Well, I think the reason people join KKR in large part is because it is such an entrepreneurial culture too. We empower our people. We encourage them to work and collaborate together. So we don't believe in silos. We hate silos at this firm. We still operate KKR today, 48 years later, as one firm, one global P&L that everyone's paid off of. So that collaboration, that one firm, is really what the secret sauce is at KKR today.
You talked about really ambitious goals across 3 platforms. We can go over them. This idea of asset management, the insurance unit, the General Atlantic, and then strategic holdings, which you kind of described. I would just say, some people might say a mini Berkshire Hathaway. You might say that they want to be a mini KKR, but why is Berkshire Hathaway kind of what you're going for in terms of what this is?
Listen, I think strategic holdings is a segment that we've been incubating for the past 7 or 8 years. And Berkshire Hathaway is an apt analogy in the sense that we look at a lot of business models, why certain firms have been super successful over time. And there are a lot of powerful messages in what Berkshire has built. It's the power of long-term ownership of assets, great businesses, the power of compounding, and the real power of smart capital allocation within your business. That's what Berkshire really excels at doing. And our version of that in strategic holdings is we've built a portfolio today within our core private equity business of 19 really great businesses that we expect to own for a really, really long time. And those businesses will start generating meaningful cash flow for us in the form of dividends. We started this business 8 years ago, and as those companies grow and deleverage, they are now in a position to start paying meaningful after-tax dividends. What we announced yesterday is that dividend stream we think will be $300 million plus by 2026, doubling by 28 to $600+ million, and ultimately getting to $1 billion plus of annual operating earnings for us in that segment.
Yeah, and I'd say the background to all this is we're students of long-term value creation. And so when we became a public company in 2010, our market cap was $7 billion. It's now roughly $90 billion. And what we're focused on is how do we double that again and then do it again as we look to the future. And if you look at organizations that get above a certain size of market cap, their per share growth slows. The denominator becomes heavy. And so just like a lot of where KKR is growing today were seeds we planted 10 to 15 years ago, with insurance that we think we can double again from here, and strategic holdings that, to Joe's point, is going to have a very significant growth trajectory, we think we've created a model that as we look out for the next 10 to 15 years, we have a way to keep compounding what is now a large market cap at a very attractive rate and not slow down that growth rate. And critically, as part of all this, we've built it all, it's purpose-built, to be able to retain the culture. So we can have very few people in the firm, because we started this part of KKR with no new headcount. It was monetizing idea flow that was already in the firm.
So what are you going to do with that money? If it's kicking back all this cash, do you go out and buy some more companies? You can have 23 in the portfolio? Yeah.
Well, listen, a big part of our jobs in the next 5, 10, 20 years is how do we think about redeploying the cash we generate in our business, the capital allocation part of our job. What we talked about yesterday at Investor Day is in the next 5 years, we think we're going to generate $25+ billion of cash at KKR. So how do we redeploy that? Some of that's going to be to grow our insurance platform. Some of that clearly is going to be the right strategic M&A for us, as we've done in the past. A lot of that's going to be to grow strategic holdings, this new segment, and a lot of that's going to be for share buybacks over time.
What's fascinating to me is a lot of people in the industry are saying that private equity is not going to have the same kind of returns going forward. That the equity is part of the composition isn't as lucrative just because of how high valuations are. There's so much money chasing, so few companies. The exits are concerning. Are you moving in the opposite direction? Are you saying that people are kind of missing the boat a little bit here, Scott?
I think what we hear a lot of that, and it makes us smile. I mean, the business has continued to evolve. When Joe and I joined, we had something like 15 investment people. We now have hundreds around the world, and we have several different capabilities that we've built to supplement that. If you show up as just a financial buyer today, you're not going to be able to do what we do. We show up, we've got teams that are sometimes 30, 40,